excuse me, in the session, and to feel free to introduce yourself in the chat and say hello and let us know which organization you're joining from as well whilst we're waiting. And we'll get started just momentarily. Just give it a few more seconds. I see lots of attendees joining us, and then we'll be getting started. Okay, welcome everyone. Hi to those who've just joined us in the session. It's great to have you here with us. So please feel free to introduce yourself in the chat if you'd like to whilst we're getting started. But I can see we have now well over 100 attendees with us, and I know many more on their way. So I think it's a great time to get started. So as I say, a big welcome to this day or half day of training on applying the IFRS Sustainability Disclosure Standards. So I'm Fiona Quinlan-Wells from the UNSSE team, and it's great to be here with you. This program is really a very collaborative effort. So we've seen a lot of demand globally for more capacity building to implement the IFRS S1 and S2 standards. And so we'd like to say a big thank you to our partners on this training, to the IFRS Foundation and IFC, our partners on the program, and of course, a particular thank you to the Chittagong Stock Exchange for hosting the session with us today and bringing you here together with us. And finally, a big thank you, of course, to everyone joining us for the training session. We know 3.5 hours is a long time to take out of your day, and we're really appreciative of that time you're investing with us today to learn more about this topic. So to get us started, I'm very pleased to say we're joined by Mr. M. Shafar Rahman Mazumdar, the Managing Director of the Chittagong Stock Exchange, who'll be giving us a short opening comment. So many thanks for joining us, and the floor is yours.
Thank you so much. Dear participants, hosts, resource persons, Assalamu alaikum and a very good afternoon. It is our great pleasure and honor that Chittagong Stock Exchange of Bangladesh is hosting this workshop on IFRS Sustainability Disclosure Standards S1 and S2 jointly with UNSSE. I'd like to extend a warm welcome to all participants of this workshop, particularly different stakeholders of Bangladesh capital market, regulators, exchanges, listed companies, market intermediaries, academia, etc. We, on behalf of Bangladesh capital market community, would like to appreciate and thank to IFRS Foundation to provide expertise support for the workshop. We'd also appreciate the initiative of UNSSE and IFC for partnering with IFRS Foundation to promote sustainability-related disclosures in capital markets worldwide through promoting IFRS. In Bangladesh, different regulatory authorities have been promoting implementation of IFRS, the common language of disseminating financial reporting. It's a rapidly growing country an ideal place for investment. Promoting sustainability-related disclosures through IFRS would help a great extent in building capacity, transparency, as well as trust of the community. I am sure this workshop will enrich our knowledge and capacity to contribute further in the development of Bangladesh capital market through promoting financial reporting. I am thankful to the resource persons for the workshop and welcoming all the participants, wishing the workshop a great success. Thank you all.
Many thanks for that opening, Shofar. We really appreciate you being here, for joining us, and for setting the scene so well for the session. That's very much appreciated. So with that kind of great opening to the session, we're now going to move into covering a few points just in introduction. So firstly, just a few housekeeping points from my end. So firstly, you will have noticed by now that as participants, you are on mute during the session. However, that isn't to say that we don't want you to participate. So please make sure to use the chat function, as I see that many of you are already doing, if you'd like to make any general comments or to introduce yourself to other attendees. And then secondly, you have the option of the Q&A box as well. So if you use the Q&A box in particular for any questions you have, that will be easiest for us to track and respond to those questions. So make sure to take the advantage of that opportunity to get your question answered as we move through the session. So in terms of format for today, so we have 3.5 hours of live facilitation in the training, and we have an optional homework assignment, which we'll talk about a bit more later in the session. As I've already said, there's the live opportunity for questions to be answered throughout the session. So I'll be introducing my other speakers shortly, but lots of experts here who'll be able to help you. So please make sure to use the Q&A box to ask your questions and get those answered. We do, as I say, very much encourage your participation in the training. So we're going to be using a number of interactive features, including Menti and some polls. So we really like you to take part and encourage you to do those as we go along. And then finally, if you complete the training today, you'll be eligible to receive a completion certificate. And to do that, you'll need to fill out a feedback survey, which we'll share with you at the end of the session. So just to introduce who will be delivering the training. So as I said, I'm Fiona from the UN SSE team, and I'm joined by my colleague, Lois Guthrie, our senior specialist, who's just given you a wave there on camera. And then we're very pleased as well to be joined by our colleagues at the IFRS Foundation, based within their capacity building team on the sustainability front. So firstly, we have Robert. Hi, Robert. And we also have Vanessa as well. So as I said, a real great mix of experts to help you to understand these standards and take us through the session. So great to have everyone with us to support that. So in terms of our learning objectives from today's training, we have 3 key areas we're hoping to help you move forward. So firstly, we'd like to help you to understand the ISSB standards. Fundamentally, what are they? We'd then like to help you to understand how you can use the ISSB standards and start to apply them within your organizations. And then finally, we'd like to help you to identify the steps that you can take to develop a disclosure plan to apply the ISSB standards. So keep in mind as we move throughout the training, those are the 3 key areas we're aiming to focus on today. So to help us achieve those objectives, we've broken down our agenda into 4 key modules, which you'll see in that wheel diagram on the screen at the moment, to really help us take it step by step through each of those topics. So firstly, we have our prepare module, and that's all around building on existing knowledge of sustainability reporting, understanding its purpose and how the ISSB standards have evolved from that landscape. Secondly, we have align, and that's all around setting the direction of your reporting. So thinking about how to apply and use the standards and what additional disclosures you might need to add to your reporting. Then we have implement. So this is all around the practices and systems that you'll need to implement within your organizations to help you to identify, evaluate, and integrate sustainability risks and opportunities. And then finally, we'll finish with communicate. So this is all around the final format of your reporting. So thinking about the location and timing of disclosures and how to do so with efficiency and confidence. And so just to see how those modules break down over the time in the session, we'll split the content kind of sequentially. You'll notice we take a short break in the middle just to refresh ourselves. And I would also note that Module 2, Align, is quite a large one. So just to note, we'll be well more than halfway through the session when we've completed Module 2. So don't worry on that front. And then we'll wrap up at the end with a little bit of an overview of the optional homework assignment and share some additional resources with you as well to support your ongoing learning journey. And just a quick highlight at the start of the session. So to mention that all of the training materials we're going to be talking about in today's session, so that includes the PowerPoint slide presentation we're using now, the homework assignment as well will be available on the SSE webpage for today's workshop under resources. So Lois, thank you, Lois, has just shared the link to that page with you in the chat, and we'll remind you of that and share it a number of times. But if you go to that page at the bottom, you'll be able to find the slide presentation, which will include links to everything that we're mentioning in today's training. And we'll also post the recording for the training after the session on that page as well. And as I've mentioned, there is an optional homework assignment which you can take away after the training, and you can access that from the same webpage in the resources section. And the idea of the homework is to help you to develop a draft disclosure plan and put into practice what you've learned in today's training. So there's no need to submit the homework to us, and it isn't mandatory to complete. It's really just for your own learning and to help you to build on this internally with your colleagues. So feel free to do that if you'd like to, or if you're not into homework, that's absolutely fine as well. I see someone found that one a bit funny, but it is funny to be setting adults homework, I know, but more about continuing to support your learning internally with your colleagues. And just to mention a few key resources that we're going to be using in the session and we'll be talking about a number of times. So firstly, we have the SSE's toolkit of different resources that we've developed on this topic. So you can find those at the link that Lois has shared with you in the chat, or follow the QR code in the slide presentation as well. But lots of different resources to support you in building your understanding on these different aspects of sustainability reporting. Okay, so that's just a bit of an overview from my side, but to get us started, we want to get familiar with using Menti together and to get you to give us a few thoughts from your side to start us off. So we'll come back to Menti a few times during the session, so it's worth finding the way into Menti now so that you have that available for you later. So Lois is just about to share in the chat with you a link to access the Menti that we're going to be using. So if you follow that link once it's there, then that will take you through to our first question, which is all just to get a sense from everyone as to why you're joining us here today and what you're hoping to get out of the session. So I can see Lois has shared the link, so thanks for that. And what I'll do now as well is I'll share my screen, and that will show you another way that you can join us in Menti as well, if it's easier for you to do so that way. So as I've said, following the link that Lois has shared is probably the easiest option, but you have two other choices. You can also use that QR code that you're probably seeing on the screen now, and you can also go to menti.com and use that 8-digit code that you can see at the top of the screen there as well. And once you're into Menti, feel free to just share 1 or 2, up to 3 words to let us know what you're hoping to get out of today's training and what you've joined for. Good afternoon. Good afternoon to you too. Okay, I see learning, implementation, knowledge, what not to do, maybe, and demonstrations, executions, maybe networking as well, an application, net zero perhaps as a topic. See, Mohammed has shared in the chat as well around knowledge gathering, expanding the company, gaining more knowledge. Some people saying hello, hello to you too. Great to have you here. Okay, fantastic. Well, I think you're all hopefully in the right place for those different focus areas. That's definitely what we're trying to do today, is to help you build that knowledge and learn more about these standards. So you're in the right place, as I say. So thanks everyone for sharing. Okay, so I'll move to our second opening question that we had from you, which is just to get a sense of how comfortable you are currently with the different tasks and areas that we're hoping to expand on in today's session. So you'll have a scale available on the screen where you can select from the left-hand side, maybe not familiar or not experienced in these topics, through to the right-hand side of the scale if maybe you already have quite a lot of knowledge and you're quite comfortable talking about these areas already. But just to let us know quickly where you're at currently in terms of explaining what the ISSB is, using the ISSB standards, and in developing a sustainability reporting strategy. Just good to always get a sense of where we're at the start of the training, and we'll come back to see at the end of where we think we are now. Okay, so I see quite a range, I think, in the responses we've had so far. So quite a varied scale, but overall, most people somewhere in the middle of comfort levels, maybe some familiarity already, but a few things to learn. I'm feeling perhaps more confident on the general topic of sustainability reporting than the specifics of the ISSB, which of course is very understandable. So that's great to get that understanding, and we hope we'll be able to help move you along that scale in the training today. Okay, brilliant. So that's all from Menti for now. I would recommend if you want to keep the tab with Menti on open, we'll use the same link when we come back to it later in the session. But for now, I'm going to give us a bit of an overview and cover off our first module. Just take a good of water first. So firstly, just a quick disclaimer that I'll leave a moment for you to review. So this is really just to be clear about how we're going to be using examples in today's training. These are really simply here to help add some colour to what we're talking about. Sometimes we know it can help to see a real example to put into practice the discussion. However, these examples shouldn't necessarily be seen as the best or the right way to approach this. Of course, we know that each company's circumstances are unique and you need to do what suits you best. However, we hope the examples that we share can provide some inspiration to help you. Okay, with that disclaimer covered off, just to launch now really into our first module, I'll be covering off the prepare, kind of solid foundation of knowledge side of things before I hand over to some of my colleagues to carry on the session. So firstly, this side is really around trying to build on what you might already know about sustainability reporting, and to demonstrate really that the ISSB standards connect very strongly to what's already in place in terms of voluntary reporting. So here we generally like to cover three important aspects. So firstly, the purpose and why to disclose sustainability information, maybe what the market and business drivers for it will be. Secondly, the landscape, so thinking about how the reporting landscape has evolved, including how it's becoming simplified. And then finally, the global baseline, so introducing the core concepts and requirements of the IFRS S1 and 2 standards that form that global baseline. Okay, so getting us started, we're going to focus then on purpose to begin with and thinking about the drivers and the market case for sustainability disclosures. So to get us rolling on that, we have a poll question to get a sense from everyone here as to what your reasons are for disclosing sustainability information. So I'll just launch that poll for you now, and you can select as many of these options as are valid for you. But if you can let us know for your sense and your organisation, what are your reasons in particular, primarily for focusing on sustainability disclosure? Maybe you're not reporting yet as well, and that's fine. Feel free to let us know that. Or perhaps you have other reasons as well. So please let us know in the chat if there's any other reasons that you might have beyond those ones we've listed there. I'll give everyone a moment just to have a think and let us know your thoughts there. Hey, we always like to see as many people taking part in the polls as possible, and we'll be coming back and using them again later in the session several times as well. So do encourage you to take part in the polls. I see we're almost up to half of participants taking part, which is always our milestone to get at least 50%. So I'll wait a few seconds for a couple more of you to participate, and then we'll have a look at the results together. Okay, I think we'll close the poll there then, and I'll share those results with you. So it looks like the top driver there is coming out as regulatory requirements, and maybe quite a lot of you highlighting perhaps investor interests and sharing your own management's objectives as other key drivers, but primarily regulatory with the other factors as well. So really useful to get a sense of that from you all. So thanks for sharing. Okay, so we're going to look now at a few of those drivers and understand them in a bit more detail. So starting with the investor perspective, which I know a number of you highlighted there as one of your reasons for focusing on this topic. I think it's fair to say that we've seen a strong growth in investor interest in sustainability topics in recent years. And one potential indicator of this is the number of investors who are now signatories to the Principles for Responsible Investment. And you'll see that's now at over 5,000 signatories, showing a big growth in recent years, although leveled off a little bit since 2021, but obviously from a low base, perhaps back in 2017, we've seen a big increase. So what is it that's driving this interest from the investor community in sustainability? And I think what we want to highlight here is that the key driver behind this demand from investors is the potential financial effects of sustainability issues. So this data that we're showing on the screen comes from a study of retail investors, which was done by Morgan Stanley. And here they found that the top driver of at least individual investors, which was driving their interest in sustainable investing, was the financial performance of sustainability issues. So you can take a closer look at this study by following the link in the handout. But really what we want to highlight here is that investor interest in these topics isn't just coming from the perspective of having a positive impact, but really because there's a feeling that these factors are going to become increasingly relevant from a financial materiality perspective. So it's important to remember that today we're talking about disclosing financially material sustainability related information. So we're going to discuss in more depth in the workshop what the word material means, but we wanted to be clear from the start about what sorts of financial effects investors are looking to have more information on. So starting with effect on a company's performance, and this is often seen in the statement of profit or loss, so showing income or revenue and expenditure. And sustainability related risks and opportunities can have a financial effect, potentially by changing the mix of revenue or total revenue of a company. If, for example, demand for products and services might change, or perhaps production capacity might be disrupted, as another example. And we could also see changes in expenditure if, for example, operating costs might increase due to energy prices increasing, or perhaps if there's a need for greater R&D expenditure to capitalize on sustainability related opportunities. Or maybe there might be other costs as well associated with deploying new practices. So those are some examples of how sustainability risks and opportunities could have effects on financial performance. And then the second aspect you're going to hear us talking about today are effects on a company's financial position. So let's also look at what that means. So we can often see a company's financial position on their balance sheet, also known as the statement of financial position. And again, for example, a company could experience changes here. So for example, certain assets or liabilities could be impacted due to climate or sustainability issues. For example, we could see changes to portfolio value, or possibly we could even see write-offs of certain assets that are damaged or need to be repriced. And another financial effect that needs to be documented is changes to financing and the cost of capital. And so this can include, for example, insurance premiums that might increase as a result of climate risks, or also making use of new financing structures, for example, green bonds or social bonds as well. So those are just some examples, as I said, to demonstrate how sustainability issues might start to impact both financial performance and financial position. So keeping in mind the end goal is to disclose that type of information here. And before we move into our next unit in this module, I just wanted to flag two final concepts that are really important in understanding sustainability risks and opportunities and to making disclosures on them. So you might have seen this diagram before, which comes from the Global Risk Perception Survey carried out by the World Economic Forum. And I think what we want to highlight here is that risks evolve over time. So something that might pose a significant risk 10 years from now might not be high on our minds today. But what's important for our disclosures is that we're preparing for those risks that we're expecting to arrive over a longer term time horizon. And in preparing for those risks, we might also have to invest today in new practices or processes to mitigate negative impacts, or perhaps to capitalize on opportunities as well. And so all of that means that although something could be a long-term consideration, we might actually start to see financial effects now as we start to manage that issue. And another important aspect of sustainability-related risks and opportunities is their interconnectivity. And so this visual here also comes from that same World Economic Forum report. And as you can see here, there are, of course, many connections between different risk types. So whilst people might think of the two ISSB standards we're going to be talking about today as separate topics, one for climate and one for other sustainability topics, however, all sustainability risks and opportunities are, of course, very much interconnected. And therefore, separating out a topic or theme for disclosure doesn't remove these interconnections. And so we have to try to consider the whole when we're making strategic decisions here and when we're reporting on these issues. So it's also important to keep in mind if we're disclosing information, for example, about climate change aligned to the S2 ISSB standard, you must also think about applying the requirements of IFRS S1 on other sustainability topics insofar as they relate to the disclosure of particular climate risks and opportunities. Okay, so that just gave us as a bit of an introduction really to the purpose side of things and that why. So I'll be handing over to Lois now, who's going to be taking us through the landscape side of things.
Thank you, Fiona, and hello, everybody. So we've briefly looked at why sustainability disclosure is important, and we're now going to look at how the IFRS sustainability disclosure standards have developed over time. But before we do that, we're just going to have a Zoom poll where we'd like to ask you, please, what frameworks are you currently using for your sustainability reporting and disclosure? So you can choose as many answers as apply. Are you responding to CDP's questionnaires? Are you using the Global Reporting Initiative standards? Or perhaps the Integrated Reporting Framework? Or the Sustainability Accounting Standards Board standards, Task Force on Climate-Related Financial Disclosures recommendations, the principles of the UN Global Compact, or if it's something else, please tell us what that is in the chat. I'll give you a moment to think about that. Oh, audit, yes. Thank you. Somebody has said they use audit standards. Quite good participation here, so I'm going to end the poll and share the results with you. And you'll see that the majority of you are using the integrated reporting framework. Good to know. Followed by Global Reporting Initiative standards, some of you responding to the CDP questionnaire, and there are other frameworks and standards that you're using too. So that's very useful to know. We'll come back to talking about integrated reporting shortly. For now, let's look at the structure of the IFRS Foundation, which is the organization that has created the standards that we're talking about today. So the IFRS Foundation is a not-for-profit public interest organization that was established to develop high quality, understandable, enforceable, and globally accepted accounting and sustainability disclosure standards. You see at the bottom of the screen that there are two independent standard setting boards within the foundation. The International Accounting Standards Board was formed in 2001. It develops financial accounting and reporting standards, and those are in place in over 140 jurisdictions around the world. The sister organization, the International Sustainability Standards Board, was formed in 2021 and released its first two standards, IFRS S1 and S2, that we'll be talking about today. They were introduced in 2023 following strong market demand for its establishment. So because these two boards are both within the IFRS Foundation, they work closely together to ensure that their standards complement each other. And governance of the boards is provided by trustees, and they are in turn accountable to a monitoring board of public authorities. So how did the ISSB standards evolve? Well, this slide can look rather confusing and busy, but main message here is that we see a picture of increasing simplification and harmonization, and that is evidenced by the arrows that we see. So those of you using integrated reporting, you'll notice at the bottom of the screen that the integrated reporting framework, along with the CDSB standards and the Sustainability Accounting Standards Board standards, have been consolidated into the work of the IFRS Foundation and were used to form the basis of the sustainability disclosure standards that we're talking about today. Those of you that have used the TCFD recommendations will know that the TCFD has concluded its work, and its work forms the basis for the ISSB standards as well, and adoption of climate reporting is now monitored by the IFRS Foundation. The Transition Plan Task Force work has also been taken into the IFRS Foundation insofar as it relates to disclosure, and we'll talk about that more in a moment. CDP on the right-hand side of the screen, they've aligned their climate questionnaire with IFRS S2 on climate disclosure, and GRI and the IFRS Foundation have a memorandum of understanding which commits them to jointly identify and align common disclosures. So as I said, simplification and harmonization is depicted here. Let's do another Zoom poll now. So having heard what we just said about harmonization and simplification, what do you think is the answer to this question? Companies that disclose using the TCFD recommendations automatically comply with the ISSB standards. Is this true or false? You can only pick one answer, of course. Give you a moment to think about that. Good. I'm going to end the poll and share the results. Most of you have said this is true. Some of you have said it's false. It actually is false. Now, those who already use the TCFD recommendations will be a long way towards conforming with the ISSB standards, but there are some differences between the TCFD recommendations and the ISSB standards, and that's why the correct answer is false. So let's have a look at that in a bit more detail. Well, as we said, TCFD finished its work about 2 years ago, and IFRS Foundation now looks after climate disclosure. The differences between the S2 and the TCFD recommendations are summarized in the document that we've linked on this slide, but they're really just three types of differences. The first is sometimes S2 uses different wording, but actually means the same thing. Sometimes S2 requires more detailed information than TCFD. An example is S2 asks about how carbon credits are being used to satisfy targets for carbon reduction, for example. And thirdly, S2 provides additional requirements and guidance in some cases, and an example of that is the S2 reference to the use of sector-specific standards that we'll be looking at in a moment. Let's turn now to thinking about what was the main objective of the IFRS Foundation, which was to set a global baseline for sustainability information. And that global baseline was intended to enable comparable and consistent sustainability disclosure across global capital markets. And the foundation is working with jurisdictions around the world to achieve this, as we'll see later. But on top of those standards that are designed to provide this common language and to meet the information needs of investors around the world, the building blocks approach that you see in this picture recognizes that regulators, stock exchanges, and others might want to add disclosure requirements to the global baseline. And that is perfectly fine. That's why the global baseline has been designed as it has. So a building block would involve disclosures that go beyond the remit of the ISSB standards. So they could include the types of information that GRI asks for because they serve the information needs of a wider group of stakeholders than just investors. So taking this global building block approach with the baseline and the building blocks reduces the need to duplicate information by having the globally consistent baseline of disclosures whilst allowing additional information based on standards like the GRI standards to be added as building blocks. Just quickly to say here that there has been a global backing for this approach. The approach set out in the ISSB standards as a global baseline. The International Organization of Securities Commissions, they announced its endorsement of ISSB standards and have asked their 130 members around the world to consider how they can incorporate ISSB standards into their frameworks. There is complementary work going on by the International Auditing and Assurance Standards Board. You've probably seen the new assurance standard for sustainability disclosure. Jurisdictions are working with the ISSB to consider how they can adopt the ISSB standards. And of course, there are programs like this one today to help market participants understand how they can voluntarily opt to apply the standards. So that's the background. I'm now going to hand over to our colleague Robert from the ISSB to start introducing us to the standards themselves. Over to you, Robert.
Yes, thank you. Thank you, Lais, for this introduction. Indeed, we'll be moving on and now be talking about the standards themselves. So we talked about the business case and the market case for sustainability reporting, and the evolution also of the landscape and how it's being simplified and rationalized. And now we'll introduce IFRS S1 and S2 standards. So as we start, there are some important important key terms that should be understood. And you can find the definitions in your handout, but I wanted to briefly mention them here. So first of all, we will be saying the phrase sustainability related financial information quite a lot. And this can refer to broad set of issues, including climate, nature, biodiversity, human or social and others. Sustainability related financial information is information about companies' sustainability-related risks and opportunities that is useful to investors in making decisions about providing resources to the company. Sustainability-related risks and opportunities are those that could reasonably be expected to affect the company's cash flows, access to finance, or cost of capital. So that means that it could affect the company's prospects. We also would often refer to general purpose financial reports, which includes the company financial statements and management commentary. You might know this as a management report, management review, or strategic report, and some regulators require specific disclosures in certain parts of general purpose financial reports. So we would use this generic phrase throughout this course. Okay, and now moving to the next important concept, core content areas. And anyone already familiar with TCFD will recognize the same four core pillars or content areas for the ISB standards. These are governance, strategy, risk management, and metrics and targets. Sorry. For each content area, there are a set of key disclosures to be addressed, and the standards provide very detailed guidance on these requirements. We will discuss each of the four content areas today, but I encourage you to download the standards as part of your homework assignment. Okay, so let's start exploring IFRS S1, which sets out general requirements. So to all the preparers listening, let me start by saying, don't be afraid. There is a lot to understand, but you might be surprised that some of the detail that we are already familiar with some of the details. For all the accountants listening, you too will be relieved to see that many of the conceptual foundation developed by IASB in the ISSB standards. So the ones, the accounting standards, which are there for a long time, will be also present in the ISB standards. So let's start with IFRS S1, or to give you the full title, General Requirements for Disclosure of Sustainability-Related Financial Information. So as the title suggests, the IFRS S1 sets out general requirements for the content and presentation of sustainability-related risks and opportunities. Again, if you're familiar with TCFD, you will see the same architecture applied throughout the standards. So S1 asks preparers to refer and consider the applicability of the SASB standards and other sources of further guidance to identify sustainability-related risks and opportunities and identify material information. The SASB standards are organized by industry, enabling a company to identify disclosure topics and metrics applicable to its business model and operations. So finally, the standards can be used in conjunction with any accounting requirements. So that's about IFRS S1, and be moving to IFRS S2, so climate-related disclosures. So as we just said, the scope of S1 is all sustainability topics except for climate, which is covered by S2. The second standard focuses on climate disclosures building on the same foundation of S1. So, for example, it fully incorporates the recommendation of TCFD, sets out the requirements for a company to disclose material information about its climate-related risks and opportunities, and it requires the disclosure of both cross-industry and industry-specific informations. In terms of climate-related risk, these include both physical and transition risk, to which we'll come back later. Other specific climate-related disclosures are required, for example, on the scenario analysis and greenhouse gas emissions. Preparers must also refer to and consider the applicability of industry-based guidance on implementing IFRS S2. As we just said already, this is organized by industry, enabling the company to identify its climate-related disclosure topics and metrics applicable to its business characteristics. All right, and So how to understand the relationship between the two? S1 and S2 are not standalone standards. They are a package and must be applied together. Even when a company is reporting only on climate-related risk and opportunities, the company must apply both S1 and S2. This is because IFRS S1 sets out general requirements or parameters for the type of the information that needs to be provided in order to be decision useful for investors. IFRS S1 also explains the concept of materiality and how companies identify material sustainability-related financial information. All right, and next we will explore and consider some of the so-called conceptual foundations that underpin the ISB standards, which might be new to anyone without accounting background. These concepts help us to understand how best to disclose information in order to meet the requirements of the ISSB standards. To start with, companies must fairly present a complete set of sustainability-related risks and opportunities. Fair presentation means fair presentation also requires disclosures to be faithfully represented. To achieve this, companies shall provide a complete, neutral, and accurate depiction of sustainability-related risks and opportunities. The reporting entity concept requires the organizational boundary for sustainability-related financial disclosure and financial statements to be the same. Another important concept is connected information. We saw earlier when Fiona explained how different risks are often interconnected. The ISB standards require companies to clearly identify key connections, such as those between risks and opportunities, connections between the four content areas, and connections between sustainability-related disclosures and the main financial statements. And how these conceptual foundations can be applied in the real world. We'll have an example for that, and that will be presented by Lois. Over to you, Lois.
Thank you, Robert. And just to remind you of the disclaimer that Fiona gave us earlier, the examples we present to you today are really to inspire you and to illustrate some of the practices that we've seen by examining the reports of some large companies. So please bear that in mind. So the first example we're going to have today is to illustrate what Robert was just talking about, the concept of connected information. And the example is from a company called BHP, which is a global mining company, and it's from their 2024 annual report. So this extract tells us about connections between different things. The first paragraph tells us that climate risk assessments and climate scenario analysis are integrated into the company's strategy and treated as a sensitivity in the company's capital allocation process. So we can see from that the business strategy is connected and integrated with climate risk assessment, climate scenario analysis, but also the capital allocation process. So we can see that the company has an integrated view here. In the second paragraph, the company is telling us that some of their assessments, in particular on physical climate risk, are still in progress. However, when they get the results of the physical climate risk studies, they're going to use them to inform updates to their risk profile and risk management activities. So we can see that physical climate risk studies are connected to and integrated with the company's risk profile and management activities. Finally, on this example, in the light grey text at the bottom of the screen, you can see that the company is connecting us to further information in the report on the impacts of climate-related risk on their operations, what are the GHG emissions across the value chain, and they show us the connections with the financial statements and with production revenue and expenditure. So a little summary there of an example that shows us in real life how companies disclose how information is connected. Back to you, Robert.
Great, thank you, Lois. Lovely. Then let's then recap and then test your knowledge a little bit and the topics we just covered. So for this we have a Zoom poll, and so the question is, what information should be considered for connected information? And we have three options here. Please do select all which apply. So is there a connection between governance, strategy, risk management, and metrics and targets, or the four pillars of the disclosures? Or is that between the sustainability related financial disclosures and financial statements? Or is it between the related sustainability related risks and opportunities? So which of those three it's relevant, and for which of these items should we consider should be considered for connected information? And I see answers coming in. I'll give you a bit more time. Okay, I think I'm gonna end the poll right now. Let's see the results. Well, in fact, there's a bit of a split here, but as we just said, the connected information should be considered between all these elements. So all the answers A, B, and C should be are correct in this case, and we should consider connected information for between all these matters. So four pillars of the disclosures and sustainability related disclosures and financial statements, as well as risks and opportunities. So this is what you should think about when thinking about connected information. All right, let's move to the next section and the next topic, and then we'll talk about materiality. So the standards are built on the concept of materiality as defined by the IFRS Foundation. So we're going to go into this in more detail later, but this is for now just to highlight that we will be referring today to material information, which is information that, if omitted, misstated, or obscured, could reasonably be expected to affect investor decision making. So during the ISSB consultation on the exposure drafts, one of the key feedback topics was that the importance of supporting preparers, particularly those with more limited resources and those in emerging markets. In addition to the standards and application guidance published in 2023, a number of educational resources were also published, and since then others have followed, including IFRS Knowledge Hub. We are also in the process of gathering examples and case studies provided by our partners. The SASB standards were aligned with IFRS S2 to help preparers seeking industry-based guidance, and the FSA credential was also updated with more planned to come. I should also note that IFRS Foundation capacity building program launch at COP27 is a key part of the support to preparers, and the SSC training initiative is one of our most important deliverables. Okay, and then we have another example, and the question here is a bit more specific. So let's say the water is a vital input to our business, but the ISB standards do not currently have a specific standard on water. What do you do? And please, the only one answer should be considered correct here. A, do not disclose anything about the water. B, consult the sources of guidance listed by ISSB. Engage a consultancy to help decopy your competitors' reporting. I'll give you some time to think about it. See some pattern emerging, which is looking pretty good. All right, I'll end the poll right now, and we'll see the results. As most of you answered that you should consult the source of guidance listed by ISSB. This is the correct answer, so answer B. And of course, the other potential option would be to engage a consultancy to help, and that's of course allowed and might be recommended as well. So that would be also useful. So well, will be the first answer will be to consult the guidance of listed ISSB, and then potentially also engage consultancy to help you with this disclosure. All right, and now we've finalized the module 1, and then I'm handing over to Fiona for the summary of the module 1. Over to you, Fiona.
Apologies, sorry, great. Thank you so much for that, Robert. So that brings us to the wrap up on our first module. So I'll just take a few minutes now to review what we've covered so far before we do a quick exercise to wrap things up. So firstly, we reviewed the purpose of sustainability-related disclosures. And a key takeaway we hope that you leave this workshop with is that there are important benefits, both internally and externally, for collecting and disclosing sustainability-related financial information. And so if you're not aiming to make good use of the data that you're collecting to improve your own strategic decision-making, ultimately you're going about this all wrong and you're wasting an opportunity. Also, if you have operations in difficult to abate or high impact sectors, your competitors could disclose these risks and opportunities that they're pursuing, and that's going to leave your investors wondering why you're lagging, and that might start to affect your ability to raise funds. And next, we looked at the evolution of disclosure standards, the formation of the ISSB, and the aim to simplify the landscape. And when you're thinking about other voluntary disclosures, you shouldn't see those as competing with the ISSB standards, but rather building on top of them. And finally, Robert introduces to the standards and the important concepts that you need to understand in order to use them correctly. And a key point we want to reiterate here is that these standards and the guidance that come with them are designed to meet the needs of investors, and therefore they're heavily focused on those prospects that I discussed at the start of the unit relating to financial effects on performance and position. Okay, so to wrap up our first module, we've got a quick exercise for you just to get you to reflect really on what we've covered so far. So our first question that we'll be covering in Menti here is to get a reflection on how we're going to define the objectives of your sustainability disclosures. And so the possible answers to consider here would be thinking about, setting goals. So are you clear on what you're trying to achieve through your sustainability disclosures or any plans to adapt them? And thinking about what requirements it is that you're specifically trying to meet. So maybe you're looking to directly align to the ISSB standards. Maybe there are jurisdictional specific reporting requirements or other disclosure requirements that you also need to meet as well. And finally, also thinking about, the level of change that's needed from where you are now. So maybe you are just starting with reporting, so the ambition has got to be to implement, a full approach to reporting here. But perhaps you're reporting already and you just see a small incremental change that's needed. So it's just useful to take a moment, I think, to reflect on, of those different drivers and perspectives that we've discussed, which ones are relevant for you and what's your core focus that you're trying to achieve in your reporting. We think this is a good way to start out your disclosure plan by just having that clarity on what you're trying to achieve. So I'll just double check that you have it. But yeah, you have the link that I shared in the chat there to the Menti again, but that is the same link that we were already using. So if you have that open from before, it won't have changed. But I'll share the screen now and I can see some of your responses coming through already. So we'll just have a quick talk through on some of those. So firstly, I can see someone has mentioned that their main objective is around providing comprehensive and transparent information on environment, social and governance performance to meet stakeholder expectations. I think that's a nice, well-rounded mission statement there. Someone has mentioned around building trust, ensuring compliance, attracting ESG investors, and tracking progress and supporting sustainable growth. So again, a nice, clear statement, I think, to set out with. And then maybe someone's mentioned that their aim is around implementing the knowledge and methods in whatever company. So of course your objective here can be personal to you. It doesn't have to be a corporate objective as well if maybe you have a slightly different role in the ecosystem of organizations working on this topic. And so several people mentioning around building trust and enhancing transparency here, thinking about maybe redefining value by disclosing quantifiable sustainability impacts that reshape risk, pricing, and fiduciary norms. Fantastic. Executing maybe through your own company as well, if you're an entrepreneur, it's very interesting. And then this person, Matthew Patrick Pereira, has mentioned about disclosing to build trust, guide resilience, quantify impacts. I see several mentions of transparency again. Someone said that they want to let their investors as well as others know that we are doing something that will help the country in the long run, as well as making the work-life balance. Yeah, absolutely. Several people mentioning trust again, growing the company maybe, thinking about governance, providing clear, accurate, and consistent information. Aligning with global standards has been mentioned there as well. Someone from a bank here is mentioning around their long-term commitment to environmentally responsible, socially inclusive, and economically viable practices. Fantastic. Hopefully helpful just to have a moment to reflect there on that. And I think some of you clearly have already thought about this question clearly and have some good articulations already of what you're trying to achieve here. And I'm seeing that balance, I think, coming through between personal transparency within the organization and achieving your organization's objectives with meeting the needs of wider society and stakeholders as well. So of course, important perspectives to balance in this. And I think, sharing that objective and making sure that's clear with your stakeholders, both with your internal ones and maybe being clear in your reporting and saying that this is the objective that you're trying to meet can be very helpful. And I think it's good to see many of you there, as we've talked about already, recognizing the important internal benefits here, as well as those external drivers for transparency. So that's great to see. I think the other thing that some of you have mentioned and that we'd highlight is really looking to the future with this objective. So this is all around long-term resilience and meeting both the needs of current stakeholders and reporting requirements, but also trying to look ahead and adapt and be resilient to what may change in the future as well. But thanks everyone for sharing. I see more responses continuing to come through, and I think you can also scroll through those and see them. So that's fantastic as well. Brilliant. So that brings us to the end, as I said, of our module 1, and we're going to go back to the slide presentation now, where Robert will start us off on module 2.
Great. Thank you, Fiona. Yes, indeed. We'll be then moving to module 2, align, setting the direction, applying the ASB standards, and integrating additional disclosures. So now that we have introduced the initial concept, let's dive into how to apply the ASB standards, taking into account additional disclosures, including any relevant geographical or sectoral requirements, as well as peer practices and your leadership objectives. So first, in order to understand how to ensure your disclosures meet global standards, we will look at 2 concepts in this unit. The first is the main focus of this unit will be how to apply the standards to achieve a global baseline. And once we cover that, we will discuss how additional disclosures fit. So to begin, let's focus on how to achieve the global baseline. So the first thing to get started, the first content area will be governance, and this includes aspects that relate to the governance body and how management is applied. So there are a number of questions which should be asked to evaluate the governance. So to start identifying the information that will support some of the disclosures requirements, for example, as a part of a gap analysis, you should ask these questions. So if you look at the governance and management requirements, we can see that there are several that are fairly qualitative. So for example, which bodies are responsible for the oversight and management of processes, controls, and procedures of sustainability-related risks and opportunities? For example, is management responsibility delegated to a specific role or committee? So another question would be how and when they get informed about sustainability-related risks and opportunities, how these issues inform strategy, decision-making, and risk management. And this could include setting the targets to manage sustainability-related risks and opportunities. Whether progress against these targets links to executive remuneration, that will be another matter which should be discussed and considered when disclosing about governance. So for more information, you can make the use of the SSE checklist tool. But remember, it's not a replacement for reading and using the full ISB standards. So we'll take a couple of examples now of this to see what it means in practice. Over to you, Lois.
Thank you, Robert. So the first governance example we're going to look at is from the integrated report of a company called Yara. And Yara is a large global crop nutrition company with 17,000 employees in 60 countries. So there's a lot to see on this screen in the very highly integrated governance model that Yara operates. Maybe you can focus on the left-hand side of the screen where we see in the green boxes in the middle that sustainability governance is where the governance of sustainability is mainly focused. But if you look at the arrow, you'll see that the sustainability governance team report to the chief financial officer, and he in turn reports to the board audit and sustainability committee. So the arrows show us the reporting line. But we also see from the arrows that the responsibility for sustainability, is shared with other departments in this integrated method, including risk management, health, safety, environment and quality, HR, and global climate and energy. We also see from the arrows how information flows between different parts of the governance model, and where there is oversight, a reporting line, or available competencies to help with governance. Finally, right at the bottom of the screen, we can see that there's a sustainability network from different parts of the organization and different functions, and that inputs into the work of the sustainability governance team. So a highly integrated model there. Of course, there's no standard example as to how a company sets up its governance. This is for the company to decide, and this is just an example. Let's look at an example now from Toyota's annual report, which I'm sure you all know is a car manufacturer, including hybrid electric vehicles. So this extract from their 2024 annual report explains the role of the Sustainability Committee within the company's governance structure. So the Sustainability Committee is one of the business execution committees that reports direct to the President and Board of Directors. We can see at the start of the screen here that the frequency with which the committee meets is about once a year or as necessary. And we can also see that the person in charge of the committee is the executive in charge of enterprise risk and compliance management. So different to the Yara example where the reporting line was into the CFO. In this case, it's to enterprise risk compliance, enterprise risk and compliance management. We can see listed the members of the committee, and again, like Yara, you can see they come from a wide range of different functions, including HR, accounting, environment, and full-time audit and supervisory board members and external experts. And finally, we can see what actions were taken, what the main agenda of the committee was in the year, that they approve action plans on sustainability, including materiality and targets. They evaluate activity results, determine the direction of the approach to sustainability, and revise the sustainability policy. And in the report itself, you can see a QR code which links you direct to the sustainability policy. So with those two little examples about governance, I'm going to hand over to Fiona to take us through strategy.
Brilliant. Thank you, Lois. So as Lois says, hopefully that makes strategy fairly clear. So we're going to look at the next core content area now. Governance fairly clear. We're going to be moving on to the next core content area, which is strategy. So strategy does have quite a few more disclosures to include than governance, but it is also really where companies can see the benefits from sustainability-related opportunities and being prepared for the risks. So as you can see here, there are 3 high-level areas that we focus on in the strategy core content area. And these are risks and opportunities, effects, and resilience. So we'll review each of these separately. Starting with the questions to evaluate here. So IFRS S1 and S2 disclosure requirements on strategy are designed to enable users of general purpose financial reports to understand a company's strategy for managing sustainability related risks and opportunities. And if we first look at the requirements related to sustainability risks and opportunities, here are some of the questions that you'll want to ask internally. So when disclosing information about risks, the information required includes a description of the effect of the risks, the time horizon under which those effects are expected. And here we need to keep in mind, as I mentioned earlier, that the financial effects could occur before the risk or opportunity itself materializes, or maybe even after, or they can change over time as well. And the last 2 questions on this list in particular look at climate. So this aligns with the requirements from S2. So here investors also want to understand what types of risk or opportunity have been assessed. And this is where we'll see companies often using the categories that have been identified by the TCFD, such as physical or transition risk. And we'll go into a bit more detail about those categories with some examples later. So both standards include guidance to support companies in identifying and disclosing risks and opportunities. And they recommend using industry-based guidance and the SASB standards in order to support this assessment. So again, let's have another look at an example to help us see what this could look like in practice. So this example comes from Mondi Group's 2024 integrated report. So Mondi Group is a multinational packaging and paper company, and they have operations across Europe, North America, and Africa. And in the left-hand extract, we can see which risks the company has identified, how the risks align with 4 key categories, and that's strategy, financial, operational, and compliance, and also the delegated risk owners for the different risks as well. And then within the report itself, there's a lot more information about these individual risks, describing them in more detail. And then climate change risks are in the strategic risk category in that list of principal risks. So in the right-hand side, they go on to further analyse and categorise these risks as physical and transition risks, as I talked about already. And they also identify the risks through evaluation processes that they describe in the report, estimating the financial impact ranges and time horizons of when they expect the impacts of these risks to be felt. And it's interesting to see when they talk about the time horizons that they both estimate when the risk impact will start, but also when they expect the fullest impact of the risk or opportunity to occur as well. So just a bit of an example of how that could be summarised. And then the second aspect of risks and opportunities that potentially might have financial effects that needs to be disclosed brings us back to what we talked about at the beginning relating to time. So you might remember when I introduced this earlier that time as a factor can be somewhat different when we're talking about sustainability related disclosures. But let's be clear here on what we're meaning by time horizons. So within the standards, you're asked to identify within what time horizon any material effects are expected to occur. And so exactly what the definition is of short, medium, and long term will vary between companies, and it can depend on many different factors. For example, your investment and business planning cycles, your organization's planning horizons for capital allocation, maybe the lifespan of the assets that you operate or own, or other factors as well, such as what your investors' assessment periods are. So whilst, as I said, these time horizons will be specific to the organization, it's important to remember that you do need to define this in your reporting. So your investors won't necessarily know what you mean by short and medium term unless you give them a quantitative definition for this. And so to look at some examples for how this could work, you can refer to that Three Horizons Framework resource that is shared in the slide link there, and also maybe compare to industry guidance and peers in your sector to see what makes sense as well. So moving on now to the second group of disclosures in the strategy category, the first section there was around identifying the risks and opportunities that could be expected to affect the company. And the next set of disclosure requirements is focusing on what exactly that effect is and where it occurs in the business. So to start tackling the disclosure requirements of the standards here, companies will want to think about questions such as beginning to describe what the effects are and understanding what responses they have planned for mitigating or adapting to these effects. And again, an example we know can be helpful here. So this example comes from global chemicals producer BASF, and it illustrates some of the projects that form part of the company's sustainability strategy, which they call Winning Ways. And this strategy includes supplying customers with products that contribute to the sustainability through reducing their carbon footprint. And the company is prioritizing projects where they see rising demand from customers and a willingness to pay more for sustainable products, as well as transformation projects that will improve the company's license to operate. And what we want to highlight here is that they're showing effects on different areas of their business model from sustainability related issues, and indeed the different parts of their value chain as well. So you can see that they're considering things both in the upstream relating to how they use renewable energy and how they work with their suppliers to procure more renewable and recycled materials. They're then thinking about their own production and the impacts on their processes relating to using more efficient ways of producing the chemicals. And then finally, on the downstream side of things, they're thinking, as I say, about the business case and the opportunities they have to sell more sustainable products to their customers. So this example really illustrates how they've considered the impacts of sustainability risks and opportunities on different aspects of their business and are starting to draw out the actions that they're taking to manage risks and to capitalize on opportunities. So sometimes one of the obstacles that companies can face when they're reporting on these effects from sustainability risks and opportunities is to understand what level of detail needs to be disclosed. And in that example from BASF that we just looked at, we were showing mostly qualitative disclosures and descriptions there. But what about quantitative disclosures? So a company is expected to disclose both quantitative and qualitative information about the current and anticipated financial effects of sustainability risks and opportunities. However, the standards also do set out a number of criteria for when only qualitative information is required, or perhaps a mix of quantitative and qualitative information. And so these criteria include the following reasons. So firstly, if a company can't separate the effects of a climate risk or opportunity from other effects, so it isn't possible to isolate the particular climate-related effect from other issues. Or secondly, if there's a very high level of measurement uncertainty, which means it's too difficult to quantify the issue. And finally, if the company itself doesn't have the skills, capabilities, or resources needed to provide that quantitative information. So now we come to the last part of the strategy component. So as I said, the first part there was what are the risks? We then talked about what the effects of those risks would be. And in this group of disclosures here, we're now thinking about how companies can evaluate their resilience to these risks and opportunities. And this really gets into the practices and processes of scenario analysis. And so at the heart of it, resilience disclosures are asking company to assess its resilience to climate change issues and to disclose the different inputs and assumptions they've used to make that assessment. So we'll dive a bit deeper into scenario analysis in a moment, but some of the questions to consider asking internally here will focus on what is the company's capacity to react or adjust to the uncertainties created by risks and opportunities. So fundamentally, how do you think those risks and opportunities will affect your business, and how prepared would you be for different potential ranges of impact? So we'll take a look at a few examples here of how different companies are approaching this. So in the first example here, we have Stora Enso, and this is a Finnish and Swedish forest products company. And then they show us in these diagrams here a projection of how they're really starting to respond within their business strategy to move away from their traditional business of forests, pulp, and wood products towards growth opportunities relating to sustainable building solutions, renewable packaging, and biomaterials. And what they show in the bottom area is that these new strategic growth areas, they're actually projecting that by 2030, they will make up 80% of their revenue compared to their traditional businesses of paper, which used to form the bulk of their sales. And so we don't have exact figures on what those financial revenues will be, but we do start to get an immediate picture of where they're expecting the growth to come from over the long term and what their long-term vision is to try and capitalize on this. And so within the detail of their reporting, they talk about how they're proactively taking steps to reposition their business and to capitalize on these growth opportunities. So starting to show how they're preparing and improving their resilience for that long-term opportunity, both to capitalize on the new growth, but also maybe because they've seen some risks as well for their traditional business areas relating to the growth, perhaps, the reduce in the use of paper. And our second example here is from Solvay, which is a Belgian multinational chemicals company. And in this example, we're particularly wanting to highlight how they've reported on the financial effects of the different climate risks and opportunities. So in particular, I want to highlight here how they're being transparent about the estimates they've used and the notes they've provided to explain how they've developed their scenario analysis. So if you're using a tool like scenario analysis, it's important that you explain to your investors how you've used it. And you can see in this excerpt that they know what assumptions they've used, including indicating which scenarios they've selected, what the source of those scenarios is from the International Energy Agency, and the different parts of their business that they've included within the scenario analysis. And then in the second table at the bottom of the screen, we can see that they report then the financial impact drivers for different risks and opportunities. And they use a qualitative scoring range here from -3 up to +3 to indicate the potential direction and magnitude of financial effect they're expecting from these different risks and opportunities. And they show under the two different climate scenarios they've assessed how those impacts will vary. Okay, so hopefully those examples helped a little bit to bring that to life, but we do encourage you as well to go into detail on the examples if you look at them in the handout, if you want to understand them a bit more fully. But just to check whether you caught one of the concepts that I covered there, we've got a quick poll question to test your understanding. And so this question here is asking, if a company is able to disclose only qualitative information and or a combination of quantitative information, about current and anticipated effects. So we covered a number of reasons there why it might be possible to disclose qualitative information. And so have a think and let us know which of those you think are valid reasons for disclosing qualitative information. Give everyone a moment to do that. Okay. Give everyone a moment more just to have a think about that, a couple more seconds, then we'll talk about what the correct answers were. Okay, let's end the poll there, and I'll share the results with you. Okay, so most of you who answered selected that you thought that the top answer was correct, and maybe about half of you or so, 38%, sorry, said that the second option is correct. And indeed, those two are both correct reasons why it would be possible to provide qualitative information rather than quantitative information. However, the third option is in not a correct answer. So of course, it's important to provide balance and transparency over both positive and negative financial effects in our disclosures. And as you saw in that example from Mondi and also from, I think, Solvay as well in their reporting there, they were providing both financial impact ranges for risks and opportunities. So important if you do have quantitative information about a potential negative risk that you do disclose that to your investors. If you expect it to be material. Okay, thanks everyone for answering that question. So that brings us on now to our next segment, which I'll be handing over to Lois for to cover a few more climate specifics here.
Thank you, Fiona. So the governance requirements we looked at earlier are in S1 and S2 are very similar. There are no specific additional requirements for climate in S2, so S1 and S2, very similar in relation to governance. But when disclosing information related to strategy, there are some additional requirements in S2, and we're going to have a look at those now. So if you haven't used the TCFD recommendations, please ignore the title because this list that I'm about to take you through applies to S2 climate disclosure on strategy. So for strategy, our S2 requires a company to refer to and consider the applicability of industry-based disclosure topics in the industry-based guidance. So that guidance is available from the IFRS website, and you'll find standards there for different industries that help you understand what topics might be most relevant to report on for your company. Secondly, S2 requires detailed information about where in the company's business model and value chain risks are particularly concentrated. So this, in the case of physical risks, this might refer to assets that are particularly vulnerable. So the standards is asking you to provide details of where those risks are concentrated and other types of risks, of course. Thirdly, in describing the effects of climate-related risks and opportunities, S2 requires a company to provide information about how it's responded to and plans to respond to the identified risks and opportunities and their effects. And this might include disclosure about the development of a climate transition plan and or how a company plans to achieve climate-related targets that it might have set. The next bullet point, I think number 4 we're on now, in S2, in providing disclosures about the current and anticipated effects of risks and opportunities on a company's financial position, performance and cash flow, S2 sets out criteria for when quantitative and qualitative information is required. So disclosure of qualitative information only is permitted in some circumstances. For example, where a company can't separately identify the effects of a risk or opportunity, or where the level of measurement uncertainty involved is too high. Next, here's a phrase we're going to come across a few times in this presentation. When preparing disclosures about the anticipated financial effects of climate-related risk and opportunity, S2 only requires a company to use all reasonable and supportable information available at the reporting date without undue cost or effort, and to use an approach that is commensurate with its circumstances. This is because the IFRS Foundation recognizes that it can be difficult to prepare disclosures about anticipated financial effects. So this easement makes things a little bit more manageable for companies. The penultimate point is that when using climate-related scenario analysis, S2 does not specify which scenarios should be used for that analysis. It requires scenario analysis to be done for the purposes of assessing resilience, but does not tell you which scenario you have to use. You just use one that is commensurate with your circumstances and that is reasonable and supportable. Finally, S2 requires information about the resilience of the company's business model and strategy to climate-related risk and opportunity. And additional information that should be provided about that is which significant areas of uncertainty the company has considered in making its assessment, whether and to what extent the company has capacity to adjust and adapt its strategy and business model over time in order to remain resilient. And of course, when and how scenario analysis was carried out, it's important to provide details of that in your disclosures and to note which scenarios or scenario were used. So I mentioned earlier that one of the responses to the effects of climate-related risk and opportunity can be the development of a transition plan. Now, the standard IFRS S2 does not require a company to have a climate transition plan, but if it does, it must disclose information about it that we're going to discuss now. First of all, though, let's think about what is a transition plan. Well, the standard defines a transition plan as an aspect of the company's overall strategy that includes targets, actions, or resources for the transition towards a lower carbon economy and could include GHG emissions reductions plans. So as an aspect of the company's overall strategy, the transition plan should be aligned with that strategy, including the business case and motivation for the transition, and also should identify the levers that are most economically and technologically feasible for the company to use to execute its transition plan. Secondly, the transition plan could be aligned with science, including what science says about the requirements for net zero to be achieved and how carbon neutrality or Paris-aligned goals are explained in terms of science. So science can also inform the transition plan. The transition plan must, of course, include long-term goals that should be supported by activities and targets to achieve those goals and interim targets to monitor progress. The transition is uncertain, of course. We don't know how the transition is going to proceed, so the plan should be transparent about the dependencies of the plan for its success and progress, what risks and challenges of implementing the plan the company might face, and what will be done, for example, about residual and unabated GHG emissions. The penultimate point is about following sector-specific pathways. Now, this recognises that transition will proceed in different ways for different sectors, and sector-specific pathways that are set out by different organisations. We'll look at the sum of the resources available in a moment, but they inform a company's transition plan. And finally, companies who develop transition plans should be conscious of how they will be evaluated by investors and other stakeholders, and ensure that the plan has the hallmarks of credibility that are also set out in various resources. So talking of resources available to help with transition planning, I'm showing you a very small selection here. Now, the diagram on the left just shows you that organisations developing resources like the Transition Plan Task Force, the TPT, and GFANZ, the Glasgow Financial Alliance for Net Zero, their work builds on top of the IFRS standards and is designed to help companies conform with the standards. So let's have a look at some of the resources. You can see there the IFRS guidance document titled Disclosing Information about an Entity's Climate-Related Transition, including information about transition plans in IFRS S2. Now, this is brand new. It was only introduced on the 23rd of June. Very comprehensive. It's got lots of good examples in it. So do have a look at that guidance, and Fiona's kindly just given us the link to it, as well as the link to the United Nations Sustainable Stock Exchange model guidance, and that recently came out as well within the last month, and that contains links. I think there's nearly 200 footnotes in there with links to different resources that could help you if you have a transition plan or you're considering one. Now, we also talked about sector pathways a moment ago, and you can see the Glasgow Financial Alliance for Net Zero. They have set out sector pathways for financial institutions, but also for real economy companies. And finally, the last thumbnail you see there is the Transition Plan Task Force Disclosure Framework, and that provides additional guidance alongside the ISSB guidance, because, as we said earlier, the TPT's work, insofar as it relates to disclosure, has now been taken over by the IFRS Foundation. So lots and lots of reading for you to do there, dear participants. But now, because we're about halfway through, we're going to take a short 5-minute break. So please have a stretch, have a drink, think of any questions and answers, questions you would like to ask us. We're going to play you some relaxing music, and we'll see you back here in 5 minutes. Hello everyone and welcome back to the training. Sorry we weren't able to play you the nice relaxing music, but I hope you had a good break. Now we're turning now to the third core content area of the standards, and this is about risk management. And as you can see from the high level description here, this category of disclosures requires report preparers to disclose information about their processes for risk management, as well as whether those processes fit into the overall risk profile of the company. So let's look at this in a bit more detail. Of course, the disclosures involve you thinking about what processes and policies are being used to identify, assess, prioritize, and monitor sustainability-related risks and opportunities, and whether and how those processes are integrated into your overall risk management process. So you might want to think about the risk management question in relation to the strategy core content area as well. When we looked at the strategy core content area, you'll remember that we were talking about the identification of sustainability related risks and opportunities, and in particular those that could be reasonably expected to affect the company's prospects. So under strategy, you're required to disclose what those risks and opportunities are. This part of the standard is asking you what processes you use to identify the risks and opportunities you disclose under the strategy component. So you might want to think about the sorts of inputs and parameters you use for risk management, whether and how opportunities are prioritized as well as risk, how the nature, likelihood, and magnitude of risks and opportunities are assessed, what is the monitoring process for the progress of sustainability-related risks and opportunities, and whether and how your processes have changed since the last reporting period. So as we said before, sometimes there are climate-specific considerations in S2, and indeed that's the case with risk management. So let's have a look at some of those. So those of you that are familiar with TCFD, just to note that the requirements in S2 are broadly consistent with TCFD, but S2 does require information about the input parameters used to identify risks, whether and how climate-related scenario analysis has been used to inform risk identification as well as resilience, and whether and how your processes have changed, as we just said, and the same principles apply to opportunities. Now, in S2, we do have a definition of climate-related risks. So that definition is in the appendix to S2. We'll go through them here. There are two types of climate-related risks identified in the standard and based on TCFD, and transition risks are the first category, and they arise from efforts to transition to a lower carbon economy, and they're often categorized as policy and legal, technological, market and reputational risks. And physical risks are from events or event-driven physical risks that are called acute physical risks, or chronic physical risks that arise from longer-term shifts in climatic patterns. So there are some examples of these in the middle of the screen. So with transition risks, the sorts of examples could be increased pricing of greenhouse gas emissions, more reporting obligations, exposure to litigation, costs associated with the transition to lower emission technologies, changing customer behavior, and uncertainty in market signals, increased costs or availability of raw materials, and so on. With physical risks, the acute physical risks arise from weather-related events such as storms, floods, droughts, and heat waves, which are increasing in severity and frequency, or from chronic physical risks from longer-term shifts in climatic patterns, including changes in rainfall and temperature, possible sea level rise, reduced water availability, biodiversity loss, and changes in soil productivity. Now, with all of these examples, what they share is that they can give rise to financial effects. They can affect the company's cash flows, its access to finance, and cost of capital. And those effects can manifest over different time horizons over the short, medium, and long term. As well as a definition of climate-related risks, we have in the standard a definition of climate-related opportunities, which refer to the potential positive effects arising from climate change for a company. So these again are defined as resource efficiency opportunities, opportunities to change energy sources, to develop new products and services in response to changing consumer needs, to access new markets, to differentiate the company against its competitors, and to improve the company's resilience through different channels such as substituting or diversifying the resources on which it depends. Lots of different examples of climate-related opportunities. And again, these opportunities manifest in financial effects, effects on the company's cash flows, its access to finance and cost of capital over different time horizons. So let's have a look at an example of how a company has disclosed its risks and processes for monitoring risks. And this example comes from a company called RS Group. It's a UK-based distributor of electrical and industrial equipment. It's got global operations. This company has analysed its climate-related risks and opportunities for a number of years, and elsewhere in the report, not in this extract, but elsewhere, they identified 10 principal risks, one of which is climate-related transition and physical risks to their business. And this extract is about some of the physical risks. So the most significant physical climate risks the company identifies relate to the impact of extreme heat on their distribution centres. So you can see that in the first line there. But also the impact of extreme weather events to cause physical damage and disruption to their customer supply operations. So you can see that in the second line. We also see on each line a little red wheel icon, and this shows that how the risk affects different parts of the company's strategy. So going back to what we were talking about earlier, you can see the connection of the risk or opportunity to the wider business strategy and stakeholders. You also see which stakeholders are most likely to be affected by the risk with the little icons under the title Connected Stakeholders. In this extract, you also see that there is a description of the physical risk. We see who the business owner of the risk is. So this tells us how the company is monitoring and managing the risk. We see the metrics used to monitor the risk and its progress and change. And at the end of the screen, we see activities and actions that the company is taking to manage the risk. So this includes the capital investments and building and infrastructure to improve, please excuse me, to improve the company's resilience to physical risk. So with that example about risk management, I'm going to hand over to Robert now to take us through the next core content area.
Yes, sorry, apologies. Yeah, indeed, we'll be moving to the next content area of this training, and then the last content area we want to cover its metrics and targets. Right. So let's start with metrics. Requirements on metrics are designed to enable investors to understand companies' performance in relation to sustainability-related risks and opportunities. So preparers shall disclose information explaining how the metrics are defined, if they are absolute or relative, if they have been validated by the third party, as well as the methodology. For example, what is the method of calculation, what are the inputs, what are the limitations, and what assumptions are involved. So that's about the metrics. Let's then talk about the second part of this category, targets. Requirements on targets are designed to enable investors to understand targets a company has set to monitor progress towards achieving its strategic goals, and disclosures then would include whether they are qualitative or quantitative, and whether they are set voluntarily or they are required by law or regulation. The metric used to set the targets and to monitor progress towards its achievements, the baseline period, that's another matter which needs to be disclosed. So the baseline period from which progress is measured and the period to which the target applies. Then further, what are the milestones and interim targets? And finally, if there have been any revision to a target, together with the explanation about the revisions. And again, to help you understand it, how can this work in practice? We have another example. Over to you, Lois.
Thank you, Robert. And this example is from a company called CLP, which is one of the largest investor-owned power businesses in Asia Pacific. This company aims to be a leading responsible power provider. This is an extract from CLP's 2024 sustainability report. Now, this example shows how the company is measuring and managing waste management and material use. So these are its metrics about that for 2024, including the percentage of pollution the company reduces through recycling and removal activities. Now, this is all done in line with the company's circular economy strategy and principles that are set out in the first panel you see on the screen there. You can see in light grey text at the bottom of the first panel that the company calculates its metrics in line with the SASB and GRI frameworks, and that's because there currently isn't an IFRS standard on waste management and material use, and we'll come back to that later. You'll also see that the metrics the company is using is to monitor progress towards medium and long-term targets that it's set for the years 2025 and 2030. So you can see the results of the metrics in the bottom, and generally they are 100% on target. They're slightly ahead of target for the waste products. You see there on the first row, and that's because the company divested one of its assets, and that's how it's slightly ahead. But it's good. Lots of the examples we've given you so far are about climate change. But remember that a company is required to report on all sustainability-related risks and opportunities likely to affect its prospects. And here we have an example about waste management and material use. So with that, I'll hand back to Robert.
Great, lovely. Thank you very much, Lois. Yes, we'll be moving further. And so we'll be talking now about some of the climate-specific considerations for disclosures on metrics and targets. So this TCFD framework included recommended disclosure, which IFRS S2 builds on and adds to as a part of the required disclosure. So for example, IFRS S2 requires disclosure of industry-based metrics relevant to companies' business model and activities. Additional disclosures are required for greenhouse gas emissions, including separate disclosures for the consolidated accounting group and associated joint ventures, and information about companies' finance emissions. In addition, IFRS S2 set out a Scope 3 measurement framework to provide guidance for preparing Scope 3 greenhouse gas emissions disclosures. So why IFRS S2 does not explicitly require a company to disaggregate its greenhouse gas emissions disclosures by the constituent gases. IFRS S1 includes requirements on disaggregation that would result in disclosures of the constituent gases being required if such disaggregation provides material information. So I'd like to remind everyone that you can access more information on climate metrics in SSE's training tool, and on this topic, we'll share the link in the chat, and you can also find it on the SSE's website. So likewise, there are some additional disclosures compared to TCFD for targets as well. So for example, IFRS S2 requires disclosures about how the latest international agreement on climate change has informed target and whether the target has been validated by a third party. IFRS S2 also requires disclosures of more detailed information of greenhouse gas emission targets, including additional information about any planned use of carbon credits to achieve a company's net greenhouse gas emissions targets. And finally, the IFRS also includes additional requirements to disclose information about the approach to setting and reviewing each target and how it monitors progress against each target, including whether the target was derived using a sectoral decarbonization approach. All right, and we'll be going a bit more technical on greenhouse gas emission metrics. So questions on greenhouse gas emissions often come up in questions on metrics and target disclosures. So we want to address some of these here briefly. So for those who might not be familiar with the different scopes, then there are 3 different scopes there. And the scope 1 includes all direct emissions that occur from sources owned or controlled by the company, such as emissions from companies' facilities or vehicles. Scope 2 includes emissions from generation of acquired and consumed electricity, steam, heat, and cooling, such as the electricity the company purchases. And scope 3, the most complex one, is then all other indirect emissions that occur in the company's value chain. So IFRS S2 requires a company to disclose its absolute gross scope 1, 2, and 3 greenhouse gas emissions in accordance with the Greenhouse Gas Protocol corporate standard, unless a jurisdiction requires a company to use a different approach to measurement. If a company is using a different measurement method, there is a transition relief to use that method in the first year of applying the S2 standard. Whether and how the company is using an internal price on carbon for decision making, that's another element which needs to be disclosed. And the third element here, which we want to mention, is whether and how executive remuneration is linked to climate change. On May 29th this year, fairly recently, the IFRS Foundation has published a new educational material presented in a Q&A format detailing the greenhouse gas emissions disclosures requirements under IFRS 2, including measurement of the greenhouse gas protocol and how to report on scope 1, 2, and 3 emissions in line with the standard. And we will be including a link to this publication in the chat in a moment. And now about the disclosing of the greenhouse gas emissions, and we have the real-life example. Over to you, Lois.
Thank you, Robert. And this example is from a company called Enel, which is an Italian producer and distributor of electricity and gas. And this extract is from Enel's 2024 GHG inventory. So they have a separate document to disclose all of their GHG emissions. And the inventory starts by describing the company's ambition to achieve net zero emissions by 2040 and to promote energy generation from renewable sources. So the metrics are connected to the strategy. And in this case, at the top of the slide, you can see the company's carbon footprint broken down by scope 1, 2, and 3 as required by IFRS S2. But you can also see the comparative analysis of the 2024 2024 results. So you see the 2022 base year in the shaded graph bars and the 2024 results in the solid blue graph bars. And you can see the trend then over time, which is a trend of falling greenhouse gas emissions. You can also see from these bars immediately that the most emissions for this company come from the scope 3 category. So this way of describing and illustrating the emissions tells us a lot about trends over time and where the majority of emissions fall, i.e. in scope 3. At the bottom of the slide, we can see part of the breakdown they give for their scope 2 emissions. So as Robert said, it's helpful for greenhouse gas emissions to be disaggregated or broken down. And that's what the company is doing here for their scope 2 emissions. So how do they break down the emissions? And bear in mind, this is only an extract. They break it down by business activity, in this case, power generation and others. They give us the source of the greenhouse gas emissions, so from electricity consumption from the grid in power plants and from electricity consumption from the grid in terminal ports in particular locations. Again, they give us the 2024 and 2022 results, so we can see the trend in emissions over time, but they also break down their scope 2 emissions by the calculation method. So we have the location-based method, which reflects average emissions intensity of the local electricity grid the company is connected to, and the market-based calculation method, which reflects emissions from electricity based on the contractual terms that the company has entered into with the provider of electricity. So a little example, but with a lot of information in it. Let's do a Zoom poll now. And we've come to the end of our training about metrics. So the question is, what is the objective of the metrics requirements in S2? So you can select all that apply. Is it to enable report users to understand performance in relation to the company's sustainability-related risks and opportunities? Is it to understand progress towards targets? Or is it to understand the company's assumptions for the future? Give you a moment to think about that one. Thank you all for participating. Sorry, we go through these questions a bit quickly sometimes in the interests of time. I'm going to share the results with you now, and you'll see that there's a spread of examples here, mostly answers A and then C and B. Now, all of these are arguably correct, but in fact, the answer we were looking for were answers A and B. The reason is to encourage you to read the standards, as Robert encouraged you to do earlier, because at the start of each of the core content requirements, the standard sets out the objective of each of these content requirements. So in the case of metrics, when you get round to it, have a look at paragraph 45 of IFRS S1, which sets out the objective of the requirements on metrics and targets, which is to understand an entity's performance in relation to its sustainability-related risks and opportunities, and to understand progress towards any targets. So metrics might also help investors and others understand the company's assumptions for the future, but the standard focuses on the first two objectives. So let's move on now. We've covered all the content areas, and we're going to look at the align section the aligned part of our training, which is about how you integrate disclosure requirements that are additional to those set out in the baseline, so that are additional to the content requirements we've been talking about so far. How do you build on the baseline? Well, first of all, why might you want to do this? I mean, many companies already disclose against voluntary and mandatory reporting standards based on the jurisdiction in which they operate, and these could be stock exchange regulations or jurisdiction-specific requirements. They can be based on local requirements and can even apply to companies in your supply chains. They could be based on policy objectives. So companies, of course, familiarize themselves with policy objectives aimed at promoting sustainability that might include things like incentives or tax cuts or subsidies for sustainable practices. Companies might also want to provide additional disclosures because they are aligning with industry standards and practices that reflect what is happening within their own sector, or they might build on the baseline because they want to or have to report to wider stakeholder communities beyond investors who require information from the companies. So let's think now about jurisdictional progress. As we said earlier, the IFRS Foundation is working with jurisdictions around the world to help them decide how to adopt or otherwise use the ISSB standards. And these interactions are gaining momentum. So as of June 2025, 36 jurisdictions had adopted, use, or were finalising the adoption of ISSB standards. And on the 12th of June, the IFRS Foundation published a major update that sets out the progress of these 36 jurisdictions. So you can find that on the IFRS website. They also they released 17 jurisdictional profiles showing what regulatory decisions had been made and how jurisdictions were aligning with the ISSB standards. So do have a look at that too. In addition, there's work ongoing to support interoperability. That is how different standards work together. There is details on the IFRS Foundation's website about ongoing sustainability consultations about the adoption of the IFRS sustainability standards. There is information about the regulatory implementation program that helps jurisdictions decide how to adopt and use the standards, and there's a roadmap development tool. So all of those can be found in the links within your slides. Let's talk a little bit more about interoperability. And the IFRS Foundation has strategic relationships with different organisations to support the interoperability of standards so that they are as aligned as possible and as common as possible to reduce the reporting burden and to standardise information. So as we said earlier, CDP has aligned its climate questionnaire with IFRS S2 on climate disclosure. As Robert explained earlier, the GHG protocol is the protocol that must be used to measure greenhouse gas emissions, and the ISSB is actively involved in updates to the GHG protocol corporate standard that's used for GHG measurement, and also involved in the GHG protocol's governance arrangements. We'll talk a bit more about GRI in a moment, but they are working together. We've already seen that the Transition Plan Task Force disclosure-specific materials have been taken over by the IFRS Foundation, and they're reflected in the Transition Plan guidance we referred you to earlier. But ISSB is also working with the Task Force on Nature-related Financial Disclosures and how they can build upon the TNFD's recommendations as they develop their work plan on biodiversity and nature. So I said we'd come back to talking about GRI because we saw earlier from the Zoom poll that some of you are using GRI standards. Some time ago, there was a study issued jointly by the organisations to show how GHG emissions requirements across GRI and ISSB standards are very similar. And we've said that there's an MOU where the organisations jointly commit to working together. But more importantly, in June, the ISSB and GRI issued a document saying that there would be equivalence to IFRS S2 of the GRI GHG emissions specific disclosures. So what that means is that if you report to S2 or GRI on your GHG emissions disclosures, they are treated as equivalent. I mentioned earlier the work that the ISSB is doing on its project on biodiversity ecosystems and ecosystem services. And in order to progress that, the ISSB will be working with the GRI and looking at its 101 biodiversity standard. And in terms of governance, the GRI Sustainability Innovation Lab was established in Singapore, and the IFRS Foundation was one of the conveners of that. So just to say something more about this equivalence, just to be very clear, if your company is reporting under GRI 102, that's the Climate Change Standard 2025, and S2, you're in luck because these standards are now aligned on GHG emissions reporting. So scope 1, 2, and 3 emissions disclosed under IFRS S2 can also fulfill the requirements of GRI, provided you use the same GHG protocol-based methodology and clearly reference where the disclosures are in any GRI content index. So that's some good news about simplification. And maybe not so much for this audience, but many audiences also consider the implications of the European sustainability reporting standards, which have been developed to support companies who are required to disclose sustainability information under the Corporate Sustainability Reporting Directive. So many companies in Europe and perhaps elsewhere are required or choose to apply both European and ISSB standards. Now, again, the IFRS Foundation is working closely with the European standard setter, EFRAG, to make sure that these standards are as aligned as possible. There's still a lot of work ongoing in Europe about simplification, but what has been discovered so far is that there's a high degree of alignment between climate-related disclosures, between the two types of standards. Of course, there are some differences as well, and those differences are mainly attributable to the fact that these standards serve different objectives and different stakeholder groups, with the European standards serving the information needs of a wide range of stakeholders. So those standards cover information requirements on impacts as well as risks or opportunities. Now, at the beginning of the training, we asked you what standards you were using, and many of you said you were using the integrated reporting framework, I think most of you. So the good news is that the integrated reporting framework has been consolidated into IFRS S2 and can still be used as a complementary tool for making your investor-focused disclosures. So when they're used together, the ISSB standards and the integrated reporting framework can support a holistic view of the value creation process, giving a complete picture of how value is created over time, and serve many other uses as well. But there's a document that you see on the left-hand side of the screen, which explains to you how you can use integrated reporting to support your ISSB disclosures. There's dedicated frequently asked questions and a mapping tool in that document, as well as a getting started guide to integrated reporting. But perhaps the most important thing about integrated reporting is it is supported by integrated thinking, and that underpins and enhances the quality of a company's corporate governance processes. So we're just going to do one final Zoom poll now before we come to the summary of Module 2. And the Zoom poll asks us, yes, that in making your disclosures, your disclosure objectives should consider the ISSB standards only, the ISSB standards and regulatory requirements, just regulatory requirements, or all of the above and other sources of guidance. So you can only answer one of these. So you have to just pick one answer. And I can already see that you know the answer, which is wonderful. Share the results with you. Of course, the final answer is correct. When you're considering your disclosure objectives, you can take into account the ISSB standards and must take account of regulatory requirements. Of course, you can also consult other sources of guidance. So well done. You all got that answer correct. I'm going to hand over to Fiona for a summary of Module 2.
Great. Thank you, Lois, and apologies for anyone who had the slides moving around a little bit there. We just had a slight technical hiccup. Great. So as Lois says, this brings us to the end of Module 2. And as a reminder, I mentioned at the start that Module 2 is our biggest section of the training. So don't worry, we're well more than halfway through our time together, but there's lots of course to cover in this topic. So hopefully it's been helpful. So just to wrap up on a few of the key things from this module. So firstly, sorry, can I just be careful, please? Any presenters who have slide control, you are moving slides. So we reviewed all 4 of the core content areas there of the ISSB standards: governance, strategy, risk management, and metrics and targets. But an important thing to remember is that these don't operate in silos. And we saw in our examples that despite having 4 separate categories of disclosure, they're all interconnected. And we also discussed how your disclosures might go beyond the requirements of S1 and S2. So as Lois talked about there, perhaps to meet the needs of different stakeholders, to meet regulatory requirements in certain jurisdictions, or to meet industry standards and requirements. And what's important to remember when you're doing this is that the ISSB standards have been purposely developed to act as a baseline. And so the building blocks approach then allows report preparers to add additional disclosures on top. However, in doing so, preparers do need to be careful not to obscure the requirements of S1 and S2 as well. So to wrap up this section, we've got another quick exercise for you. So here we've obviously discussed a lot of the requirements under a line that you might need to implement. And so probably this has already raised some thoughts for you about what gaps you might have within your organizations against these processes. So what we want to do now is just take a moment to reflect on perhaps what some of the key gaps are that are front of mind for you. And of course, to understand this more thoroughly, we'd recommend that you conduct a gap analysis after this session to help you here. And so there's a simplified checklist that you can find in the homework sheet, which is available from the event webpage that we've shared the link to previously. And on this homework sheet, the gap assessment kind of there can help you to think this through a bit further. But now it's just to take a quick moment in Menti to think together about what your key gaps might be. And this could perhaps be particular topics that are new to you that you might need to start reporting on, or maybe it could also be new processes that you might think that you need to implement internally to be better prepared to report what the disclosure requirements cover. I'll just give you all a quick moment to reflect on that. All right, I see a couple of answers coming in here. So someone has mentioned maybe the need for standardized procedures and processes. Indeed, we often see that because of maybe the slight step change that you have in the amount of detail that you need to collect for the S1 and S2 reporting compared to maybe voluntary frameworks, it might require you to take a more standardized approach, as you say, and implement more kind of clear governance processes to support that. So this is where I think we'd really recommend working with your accounting colleagues to develop, a robust approach that follows the same governance principles and due diligence as your existing accounting processes. Someone said that they must enhance transparency by clearly explaining data sources and reasoning, solidifying internal processes again, maybe identifying and mitigating biases, indeed, so trying to get a balanced picture and having definitive accountability. So yeah, I think that's some very good reflections there, and I'm sure that will resonate with others as well. People have mentioned maybe transparency has come up a few times. So yeah, perhaps there's a lot more transparency required here and more balance needed in reporting. So we've talked, of course, about the need to provide both negative and positive information. And so for some organizations, obviously culturally, getting used to providing that information externally is a difficult thing to do. But of course, as we've touched upon already, your investors know that these risks exist in the long term. And so just because you don't disclose a risk doesn't mean investors won't be assessing this. And actually, if you don't disclose that risk information, they might think that you haven't identified the issue and that you've got a blind spot. So ultimately, in the long run, providing that transparency is likely to build a better relationship with your investors. And a few people have mentioned lots of other things coming in now, so that's great. So I see also around maybe having to a materiality mapping engine sounds interesting. So yeah, starting to think about more detail on material topics and how you really assess those is indeed very relevant for S1 when you're starting to think about what the material issues are for your organization. Someone is mentioning about risk mapping again tied to materiality. Again, transparency and decision making, data privacy. Someone also here mentioning data around perhaps not having the data in their organizations or not having an integration yet of climate and ESG issues into their regular financial planning. Indeed, and obviously those two issues are closely connected, whereby you probably need more robust data to enable you to integrate things fully. So I think understanding your data gaps and understanding your priorities for what data you need to understand these topics better is a key thing to address indeed, because it won't ever be the case that you'll have perfect data for all of these topics, but where you see your most material issues, you will want to consider how you can improve and enhance what you're collecting to understand these issues. Okay, and a few of the issues being mentioned here, maybe not having standardized approach to scope 3 emissions, maybe not having the right timelines in place, and maybe the clarity on what the reporting requirements are indeed in your jurisdiction, of course, is understandable. So continuing to keep a close eye on those regulatory signals and consultations that are on the go so that you can understand what might be coming will be important. And I believe we've shared a few resources to support on that already. And someone's mentioned here maybe not having board level oversight in place. So indeed, I think trying to engage your board on this topic and help them to understand and see that this is a topic for them is important, and actually emphasizing, I think, that investor interest, the regulatory imperative that will be coming in the future, and the real strategic nature of these risks and opportunities hopefully can help to convince colleagues that this is indeed a strategic management and board issue. Brilliant. No, thanks everyone for those reflections. Hopefully just helpful to take a pause. And I think, as we said, the main thing we'd recommend here is you need to understand your gaps in order to address them. But of course, you're going to have to prioritize here. You can't necessarily tackle all of these things in year one. So thinking about, what's a priority as a foundation to have in place, and maybe what's something that you could evolve and iterate in the future is good to get some clarity on. So hopefully our resources that we've shared with the gap analysis checklist in the handout can help you there. Okay, excellent. Thanks, everyone. So that wraps us up on module 2. So I'll take us back to the slide presentation now and hand over to Lois to get us started on our third module, Implement.
Thank you, Fiona. And I wonder if we'll restore this slide control, if that's okay. But I'll tell you what we're going to talk about now. We're going to go on to the next module, which is called Implement. And this has 3 parts, this module. First of all, identify, where we'll talk all about how to identify sustainability related risks and opportunities. Then Fiona will take us through the evaluate part of this module, and that is about evaluating decisions like which scenario to use for resilience analysis, for example. And thirdly, integrate is as it says about how to integrate sustainability related practices into your existing corporate practices. So let's start with identifying sustainability related risks and opportunities. Now, so far we've talked about what to disclose, so we know what to disclose, but there is also some information in the sustainability standards about how to prepare for your disclosures. So first of all, let's look at identifying risks and opportunities. So as I said earlier, bear in mind that S1 asks companies to provide material information about all sustainability related risks and opportunities that could reasonably be expected to affect a company's prospects, and there are similar requirements for climate disclosures. But what about risks and opportunities that goes beyond climate? Well, we saw earlier the example from CLP on waste management, where they had used SASB and GRI standards to help with their risk identification and measurement. And indeed, in line with this, IFRS standards say that to identify risks and opportunities, a company shall consider SASB standards, which are available on the IFRS website, but may also consider IFRS educational material on sustainability-related risks and opportunities and the disclosure of material information. So there's very comprehensive educational material available on that. In addition, companies can consider the CDSB framework application guidance, which covers a wide range of subjects, including social matters and biodiversity and water. Companies can consider industry practice, perhaps developed by the industry group to which they belong, and the materials of investor-focused standard setters. And of course, the integrated reporting framework is one such source. So having identified the risks and opportunities using these different types of guidance, the same types of guidance can be used to consider which information you report. But in addition, companies can refer to GRI standards, just as the CLP example showed for waste management, but also European sustainability reporting standards if appropriate. So let's have a look at an example now about risk identification processes and what a company has done to manage that. This is an example from a company called Ayala, which is a Philippines-based conglomerate company with lots of different types of activities. So we'll see in the first panel called Communication and Consultation, you'll see that the company, as its primary activity for risk identification, consults with people inside and outside the organization to get their inputs, insights, and recommendations as to what the risks that they should be considering might be. It has 4 steps it goes through. First of all, it considers the context, both the internal and external factors that inform the risks that it is considering. Secondly, it has a process for assessing, identifying, analysing and evaluating the risks. So what is the risk universe? How is that universe defined, and how are the risks evaluated and prioritised? The third step the company takes is to decide how to treat the risk. So what is it going to do about it? What is the appropriate plan of action to address the risk, and what functional areas should be involved? And finally, the company has a monitoring and review process so that they can accurately represent the sort of current state of the risk universe that it has identified. So again, these considerations are embedded and integrated into its risk framework, and we'll talk about that again in a moment. Let's look at another example, though, about how a company has identified risks and opportunities. And this is an example from a company called Nest. Nest is a company based in Finland, and it's a leading producer of sustainable aviation fuel, renewable diesel, and feedstock solutions for the chemical industry. This extract comes from the climate section of the company's annual report, and it shows how the company identifies risks and opportunities in two different scenarios in a time horizon until 2050. So the first scenario is called Net Zero World by 2050, and it's considered both on a global basis, that's World 2050, but also for the EU and North America. And they've done this because economies may take action at different paces and different scales, and that's why they have divided the way in which they look at that same scenario over two types of jurisdiction. In both cases, the company anticipates opportunities from growing demand for their renewable and circular solutions in the net zero world. And on a global basis, they see opportunities to expand into new markets and sectors. In the EU and North America, they expect their supply of renewable and circular solutions to be supported by regulation and voluntary ambitions in the Net Zero World 2050. They also identify risks, of course, and these are associated with competition and the acceleration of new technologies. The second scenario that the company uses to inform its risk understanding and identification is called the compromised climate target scenario. And this is where climate action is slow and global warming of 2.5 to 3 degrees is expected. Now, in this case, the company has the opportunity to differentiate itself from others by offering renewable and circular solutions, but the risk in this scenario is that the demand for those products is constrained. Now, in all scenarios, you'll see on the bottom line under each scenario, there's the indicative financial impact to Nest. And perhaps understandably, the most positive indicative financial impact for a company that offers renewable and sustainable aviation fuel and diesel solutions is in the Net Zero World 2050. So two different approaches from IALA and Nest on how they look at risk and what they disclose about it. Now, we've used this phrase a lot before, so I won't go into it in detail, but the standards recognise that it can be difficult to identify sustainability-related risks and opportunities, and therefore to make sure that the effort involved is proportional to the benefit, the ISSB standards say that in applying specific requirements, including the identification of risks and opportunities, the company just uses all reasonable and supportable information available at the reporting date without undue cost or effort. So what does this mean? Well, reasonable and supportable information is information that is specific to the company. So it's not just general or generic, it's actually specific to the company. It takes account of the external environment, and indeed we saw that that was one of the elements of the IALA process, to take account of the external environment. It includes information about past events and current conditions. Of course, the company already knows those things, but also forecasts, perhaps reflected in scenarios, as we saw from the nest example. And in some cases, what constitutes reasonable and supportable information is specified by the standards themselves. So I'm going to hand over to Fiona to take us through the next part of the implement module.
Brilliant. Thank you, Lois. So once those risks and opportunities are identified, companies are going to need to evaluate the financial effects of the risks and opportunities. And we know that this can often be one of the most daunting aspects when first starting. So we'll briefly review a few key concepts here that we can help get started in this process. So to help investors understand a company's resilience against climate risk, S2 requires a company to disclose information about the implications of climate change on its strategy and business model. And it also asks for companies' financial and operational capacity to adjust or adapt over the short, medium, and long term. So to look at this, you're going to need to use climate scenarios and analyse how these will lead to the different effects. And it's important to remember here that climate scenario analysis isn't asking you to predict or project what's going to happen in the future. So there's no likelihood ascribed to it. It's really just a tool to test possible plausible future pathways and what your resilience to those would be. And S2 doesn't specify particular scenarios that a company should use in the analysis because which ones you use will be highly dependent on the type of risk you want to assess, the industry that you work in, perhaps the location, etc. But it does ask in the S2 standard that you use relevant scenarios and that you provide disclosure about how you've selected the scenarios and what assumptions you've used to guide your analysis. And within the guidance that sits alongside S2, there's guidance on how you could consider a range of practices here, perhaps starting with more qualitative scenario narratives and progressing towards more complex statistical modelling for most material risks and as your maturity improves. So overall, it's expected that companies use an approach that's commensurate with their circumstances and that uses the reasonable and supportable information that's available to them without undue cost or effort. So again, we'll just look at a couple more examples here to help show what this could look like. So you're probably familiar with the Swiss company Nestlé, the food and drinks company, and this output here is part of their climate scenario analysis that they include in their non-financial statement. And the image we're seeing here shows projections, I shouldn't say projections, should I? It shows possible changes in their crop yields under a medium emissions scenario out to 2040. So whether they're expecting to see decreases or increases in crop yields for different commodities. And so this is showing that potentially there could be quite significant changes in the availability and quality of key raw materials in their business that could then impact on commodity prices and the inputs to their processes. So in their disclosure alongside this, they summarize their kind of key takeaways from this analysis and what steps that they're then planning to take to try and improve their resilience to these potential issues. And so, of course, when we're talking about anticipating the materiality of future events, we know that can be quite challenging. So to help with this determination, S1 in the IFRS standards asks you to consider a number of issues to help with your determination. So in the interest of time, I won't go through all of these, but you can take a look at the detail here in the slide presentation handout if you'd like to read these in more detail. But overall, companies are asked to continue to evaluate and provide transparency in their each year's reporting about these uncertainties. So it's recognised that uncertainty is going to be there, but what's important is that you're just clear and you continue to assess what those uncertainties are, which might affect your view on long-term resilience. Okay, great. I'll hand back over again to Lois now for the final segment of this module.
Thank you, Fiona. So after identification of risks and opportunities and considering what evaluation techniques you might use, the third concept we wanted to discuss in this unit is how to integrate different practices such as risk management, governance that pertain to sustainability into your overall processes. So what sorts of considerations might apply when you're thinking about whether you can use existing systems and processes to support your sustainability disclosure? And the good news is you probably can use a lot of them, or whether you need to adjust those systems and processes or to develop something new. So the sorts of things you could do are to undertake a gap analysis to check for gaps in existing systems and processes. And we saw you had all raised that already on the Menti exercises. You need to think about whether the processes and the criteria used to support them are appropriate for sustainability related risks and opportunities that have very specific characteristics, can manifest over long time horizons and can be uncertain. Have a look at the company's internal risk controls to see how they might be used. Think about which departments and people and teams might need to be involved in assessing the processes. So which departments have the relevant processes and expertise to contribute to sustainability reporting? What are the connections between different internal and external factors that affect your sustainability disclosure? And how will you deal with uncertainties? Will there be a process for dealing with uncertainties? And perhaps, as we saw earlier, where uncertainties are so great, deciding perhaps to use qualitative rather than quantitative information. And finally, what resources are already in place or might you need to apply for through a budget application process to adapt existing systems or to develop new ones? So all of these questions relate to your homework, which is to develop on a voluntary basis, a disclosure plan for sustainability disclosure. Now, this can be a standalone strategy, so a plan that relates only to sustainability disclosure, or part of a wider disclosure strategy that also takes into account any other governance, risk, financial, procurement, etc., types of information you might be required to or choose to disclose. So the reason we recommend a disclosure plan is it helps you take control of your narrative. The disclosure requirements ask you to make disclosures about your strategy, your company's strategy, the risks and opportunity your company have identified, etc. So it enables you to be specific to your company rather than making general statements. It supports internal collaboration and knowledge sharing and cross-functional team discussions by identifying in the disclosure plan who will be involved. Will it be teams from risk management, company secretarial, procurement and finance? How will they be organized? What will be their responsibilities? How will data be sourced? And which systems and controls you can use? And it also acts as a reference point and audit trail showing what you've decided, what you're doing, and where and how judgments have been made. So these could include judgments about on which standards you'll use, how data will be sourced, whether you will seek assurance for all or some of the information you disclose, and what sign-off procedures you might use. So most importantly, I think this disclosure plan is an audit trail, a permanent record of what you're doing, and it acts as a useful starting point for disclosure as you start each reporting year. Let's have a look at an example of a basis for preparation from a company called Novo Nordisk, which is a Danish pharmaceutical company. This illustration of the basis on which they prepare their sustainability statements contains lots of the information we would expect to see in a disclosure plan. So it sets out the regulations, standards and practices the company has to or has chosen to use for its disclosures. You can see that long list in the second paragraph. The company also explains the approach and scope used for data collection and verification of its reports. It sets out when and how changes have been made to their reporting, including how they've dealt with errors and correcting those errors. They set out what they mean by the time horizons considered for the preparation of sustainability information, and they tell us what they mean by short, medium, and long term. They explain how estimates have been used and where to find more information about assumptions and uncertainties. And they give us lots of other contextual information to help us better understand how they have prepared their sustainability information. And again, as I said earlier, it's really helpful to make all these decisions before you start the reporting year, because then you'll have a good head start on your reporting. Let's do another Zoom poll now. And the question, you can only answer yes or no, but the question is a disclosure plan required by the IFRS Sustainability Disclosure Standards? Oh yes, there we are. There's the poll. Hopefully you can all see it now. Great to see so many of you participating so fast. Thank you for that. Sorry not to give you too much time on this one. Just we're a little bit over time. I'll share the results with you, and you'll see the majority say yes. You must disclose your plan. In fact, the correct answer is no. There's nothing in the standards that says you must have a disclosure plan. But there are lots of requirements that say, you must disclose the methodology that you used, or, how you have done certain things. So it is really useful to have a disclosure plan in order to conform with those requirements on explaining how you have done something. But there is no requirement that says you must have an overall disclosure plan. We're just recommending it to you because we think it's a very helpful tool. So I'm going to hand over now to Fiona for our Module 3 summary.
Brilliant. Thank you, Lois. So that brings us, as I said, to the end of another module. So you're probably familiar now that I'll be popping up to do a quick wrap up and exercise together to bring this to a head before we launch into our final of the 4 modules. So just to remind ourselves of a few key things that we covered here. So firstly, let's come back to those connections. In the last module, we wrapped up by highlighting the importance of connections between the 4 core content areas of disclosure. We then learned in this module that there are many connections as well between a company and its external and internal environment. And these connections are what we need to focus on to identify key risks and opportunities. And the second thing that we discussed in English, sorry, I was just reading that message out. The second thing we discussed in this module was related to evaluating those risks and opportunities. And a key component of that evaluation is consistency in your assumptions. Using a scenario analysis can be a very helpful tool here because it can help you to keep track of your assumptions and be clear on what they are and how you're changing and improving those over time. And finally, as we've seen, even if some of this data isn't data that you're already disclosing, it might be something that you're already collecting for different reasons. Or maybe you have the appropriate practices or processes in place to help you to collect the data you want to report. So you just might need to make some slight adjustments to be able to capture that. So wherever possible with the data, it's trying not to start from scratch. And that brings us on then really to our exercise to end the implement module, which is to have a little reflect on the existing systems and processes for data collection that you might have available that you could adapt to help you collect data on sustainability metrics. So this could be thoughts around what systems that you use, particular ways to manage the data, maybe different teams or resources you need to do that. And finally, thinking about maybe how you need to integrate this with existing processes that you already have. So it would be great to get your thoughts on, within your organizations, what do you think are the key things that you'll be able to draw from to support you here? So let me share screen again so we can see your answers coming through. Okay, so someone's mentioned here maybe some of the challenges with the climate side of things. I'm not sure if that related to this question or the last one, actually, because we were asking about the gaps and challenges there. But yeah, I think obviously thinking about scenario analysis and the new data requirements that might bring for you is likely to need you to think a little bit more about processes to need there. And as you've raised, maybe having more board oversight on these data processes is something you might need to change. So someone mentioned here about using a few different systems that they have, which is great. So maybe thinking about what they have in their financial reporting systems, their monitoring and evaluation frameworks, public financial management tools, and audit and risk management processes. Yes, I think those are all great suggestions for existing tools that likely many organizations will have or have an equivalent of that indeed will already be capturing many relevant things that can help you here. And then someone has also mentioned looking at your annual reports, maybe seeing what you're already capturing that might be relevant here, might be in a different part of your reporting than the sustainability aspect, but it could cover overlapping things. I see mentions of enterprise resource planning again, using HR systems indeed, or maybe you have existing systems to track energy usage or supplier relationships that indeed could be adapted. Maybe you need to just integrate some new requirements, or maybe you just need to get the information out of those systems to use for these purposes. So, engaging with your colleagues who manage this data to understand what they can provide you will be quite important, and sort of mapping that out against the different risks and opportunities you need to report. Someone has mentioned here around similar systems again, around looking at operational systems and thinking about, the insights you might get from that. Indeed, if you have maybe you're operating some form of assets or facilities, often you'll be tracking environmental metrics at a site level, in terms of compliance requirements, maybe emissions, etc., that could help you there. Okay, just have a scroll and see a few more options that have come through. Having good governance, indeed, of course, is very helpful for your data reporting, integrating it with existing systems. So I think those are all really good suggestions. And I think you've raised a lot of the things that we would highlight there about really having an approach that draws from your enterprise risk processes, your enterprise reporting software, etc. So I think some good suggestions, hopefully, that will help others on those topics as well. And indeed, as someone mentioned, governance is really quite foundational to reporting and collecting data. So if you don't already have clear roles and responsibilities established around data collection, if you're going to be implementing new processes, then of course that can be a really good time to make sure you have clear governance around those as well. Okay, brilliant. Well, that brings us now into our final module, which Vanessa will be leading us through. So thanks, Vanessa, and over to you.
Okay, thank you, Fiona. So we are now moving on to the final module of this training, which focuses on the when and where of disclosure of sustainability-related financial information. As with the last unit, we will have like 3 main sessions to cover. So firstly, to get us started, we will look at the location. So in this session, we are looking to clarify where sustainability disclosures should be located. Before we dive into the specific requirements, let's think about this sustainability disclosure in the context of a complete reporting package that is useful to investors. So investors already have access to a company's financial statements. ISSB standards are designed to identify sustainability-related risks and opportunities that complement the financial statements. This all come together in a reporting package that we call a general purpose financial report. The requirements in ISSB standards about what information to report are based on the existing sustainability reporting regions, focus on investor information needs and on experts of financial accounting standards. So we all know that there are other like sustainability standards, such as GII standards. So GII standards expand on sustainability metrics relevant to broader social concerns. However, ISSB and GII reporting standards share some content requirements, such as what to report. But the ISSB standards are focused only on investors' information needs and decision making. reflecting the mission of the IFRS Foundation. So our mission is to bring transparency, accountability, and efficiency to capital markets around the world. So both organizations, GRI and ISSB, take different approaches to defining materiality, but they are not competing. The GRI approach is set out and understood among sustainability practitioners, while our IFRS approach is familiar to accountants and relies heavily on management judgments. So in together, these frameworks enable companies to meet the growing demand for transparent, consistent information across financial and non-financial dimensions, aligning both investor priorities and broader social expectations. So I would like to address like a simple example. So like the simple example is where like a double materiality assessment identifies that some of the company's impacts may also create sustainability risks, which could be so significant that they are important to disclose to investors. So moving on, as we just noticed, materiality has different definitions for different reporting standards and different audience. So let's briefly recap what we mean by material information for the IFRS. In identifying material information to be disclosed, a company will first need to identify the sustainability-related risks and opportunities that could reasonably be expected to affect its prospects. So once the company has identified those risks and opportunities, it can then determine what information to provide about those risks and opportunities. That is where our material definition comes into play. The definition of material information used in S1 is based on and aligned with definition found in the IFRS accounting standards. So if you are an accountant and like from an accounting background, you may be familiar with it. So the definition is that material information is information that, if omitted, misstated, or obscured by other information, could reasonably be expected to influence investor decisions. So in simple words, the ISSB standards seek to identify disclosure of key information that matters to the investors. So an entity determines what constitutes a sustainability-related risk and opportunity based on its facts and circumstances. Entities often have like well-established process for identifying, assessing, and responding to sustainability-related risk and opportunities as part of the management of their business. So moving on, let's understand a bit more about investors like disclosing the material information. So investors have asked for disclosure of material information, and the ISSB standards have been designed to help you gather and disclose it. However, this means that a company does not need to disclose information that is not material to the investors, even if the ISSB standards include it as a specific requirements. There are a few things to remember. Firstly, to ensure the material information is clearly identifiable, that you use plain language. And secondly, ensure the material information is not scattered across your disclosure. And lastly, include any additional or non-material disclosures if it is required by the regulators like oil stock exchanges, but ensure it is clearly identified as above. So in November 2024, IFRS has also released further educational materials providing guidance for companies on identifying and disclosing material information on sustainability-related risk and opportunities. I think I somehow have like left a link in the chat box, so I strongly encourage you to take a further look. So unless it has been determined, so let's stop here to start with the to take another sample. So the question is, the information, is it launching the sample? Yes. So the question is, the information is testing the definition of the material information. So the question is like information should be disclosed in the annual report when applying SSB standards if A, omitting that information could reasonably be expected. B, it could reasonably be expected to affect the company's cash flow. And C, it exemplifies the values of the leadership team. So we are expecting more participants to answer this question. That's just like a really important question because that decides like what kind of information you need to actually to disclose on your in your sustainability report. Okay, now let's stop the Zoom poll. So we can see like most people choose A and B. Yes, the correct answers are A and B, but we can still see some of like about like 20 people, around 20 people choose like C. So unless the reason why the correct answer is A and B, unless it has been determined that the particular values being exemplified are expected to have a financial effect on the company, this may not be the information that is necessary. Okay, let's moving on. So the disclosures under the ISSB standards has to accompany the financial statements and be part of the same general purpose financial reporting package. But as one does not say where in that reporting package the information shall be provided, that is designed to allow jurisdiction-specific requirements on the location of reporting. So the most important factor to consider here is to ensure that its sustainability disclosures are provided as part of the same reporting package as the company's financial statements. The sustainability disclosure must be provided at the same time as the relative financial statements, and it should cover the same reporting period as the financial statements. So for example, if you like disclose your financial statement like annually, it should be the same reporting period. There is also like research by the WBCSD on the state of integrated reporting shows that nearly 2/3 of the companies continue to put sustainability information in the standalone reports. However, the ISSB standards require material sustainability-related financial disclosures to be included with the general purpose financial reports. So this suggests many companies to have some way to go to get their internal process and disclosure plans are aligned. So now let me stop here to move to Lewis for the example.
Thank you, Vanessa. And we're back to the company Ayala, the Philippines conglomerate, for this example. And I know many of you said at the beginning of the training that you use integrated reporting, and you'll probably recognize immediately from this example that the company is using the integrated reporting framework to communicate how they are disclosing information in an integrated way, as Vanessa just told us about. So they show which capitals they're using for the create. About effective communication here, thing to notice are that in the middle where we see the creating value orange circles, you have references to page numbers where we'll find more information about outlook, material topics, stakeholders, strategy, business activities, and so on. So you can see how information is organized according to these headings and pages. We also see that there's some icons are used to help the reader navigate information. So the little picture of the head with a cog inside it denotes the strategy, and you'll see that it relates to value generated through focused execution in the last column. So an example here of the use of the integrated reporting framework and integrated reporting to give a holistic and integrated view of where information appears in the annual report. Now, of course, all of this is based on extracts we've taken from PDFs, but of course, digital reporting is advancing rapidly, and Vanessa is going to tell us about that next.
Thank you, Lewis. So we are all familiar with like a concept of like digital reporting. So we know that like technology is an emerging consideration for disclosures. Increasingly, like the corporate reporting is moving from PDF formats like towards like information on web pages with like structured data sets, such as like those database offered by the stock exchanges. So the IFRS foundation has created the ISSB taxonomy, which reflects the requirements and accompanying materials of the ISSB standards. So the taxonomy does not introduce any new requirements. So a digital taxonomy provides the common elements or common text will lead it to make your sustainability disclosures machine readable. This makes it easier to take like large data sets and information from an entire industry and bring them all together to analyze them. Like using digital reporting, there will have a number of benefits. Firstly, it makes the reported information easier to be used for analysis. Data is structured the same across business in a machine-readable format. And secondly, the tagging information potentially allows for automated checks for quality and consistency. And more data connection and management systems are compatible with digital reporting taxonomies in improving processing and report preparation. And lastly, the text can have labels and descriptions in multiple languages. So if you report your quantitative data in one language, someone speaking another language can also understand what it means. Okay, moving on, let's move to the second unit of a final module. Is the efficiency. So following the discussion on the location and timing, let's think about ensuring efficient disclosures. We added this into our training because like there are common question that we found from the corporates is that there is a growing reporting burden. What we hope to highlight is that when done correctly, efficiency can be made to reduce that burden. First of all, it's important to understand what effective communications looks like and what it is required. Often companies think that if they just put all the information they have into one report and that everyone will be satisfied. However, it's not the case. This would be against the core concepts, in particular with like fair presentation. For example, it could be helpful to ask these questions. Firstly, is the information clear and concise? So clear means what might depend on the nature of the information. For example, whether it could be easier or clear to present information in tables or graphs or diagrams. And secondly, concise. To be concise, disclosures should be avoid like boilerplate information, unnecessary like duplication of information, and to use clear language. And moving on, we need to emphasize like the quality of information. So some preparers like watching today might be thinking to themselves like that they still don't see what all the fuss is about. Perhaps their expectation focuses on standalone sustainability report, or they haven't had such like interaction with the external audit. To the accountants watching, I say to be kind to your colleagues, help them to understand the difference in rigor and that's required to data connection, oversight, and sign off for its financial statements. So this means, for example, the disclosure include comparative information that are to be restated or as necessary. And secondly, disclosures avoid unnecessary duplication and cross-reference as required. And thirdly, information has to be material to be connected and aggregated or disaggregated appropriately. So as we just mentioned in this slide, the cross-referencing, you will take a further look. So as you may have already noticed, there may appear to be some overlap in the discussion topics. For example, you might have the same governance approach for all your sustainability matters rather than duplicate certain information. You can use like cross-referencing to enhance the efficiency of your disclosures. So cross-referencing to other reports is permitted as long as the other report is available on the same terms and at the same time as the sustainability disclosures. The cross-referenced information is assumed to become part of the reporting package. So the cross-referencing shall be applied consistently and transparently. It shall not result in the information become more difficult to understand. So let me hand over to Lewis for the example of cross-referencing.
Thank you, Vanessa. And this example comes from a company called ArcelorMittal, which is a multinational steel company. And this is what they call a reporting index, and it's a way of showing where they cross-reference to information that satisfies the requirements of the IFRS content elements and concepts. So you can see down the left-hand column, the company lists the relevant core content elements and concepts. So we've already talked about governance, haven't we? Risks and opportunities, strategy, etc. And then in the right-hand column, they tell the reader where they can find more information. So in some cases, the information is within the same report. So it will be within the sustainability report, which is this is an extract from. And in other cases, if we look, for example, under risks and opportunities, you can see that they say there's more information in the company's Form 20F, which is a US required registration form. And under strategy and resource, they're cross-referencing to the annual report. So from this example, we can see that the cross-reference is within the report or to an external report, and it's all then linked to the content elements and concepts in the IFRS sustainability disclosure standards. So back to you, Vanessa.
Thank you. So moving on, before we move to the last unit of the occasion, I would like to highlight a few mechanisms that support the adoption. So to help support this prepares to get started with the ISSB standards, we have a few mechanisms to suggest. So firstly, one simple thing to put in place was to adopt well-known terminology and concepts familiar to preparers, borrowing from ISSB, for example. And secondly, many requirements in S1 and S2 are to be applied proportionately. Recognizing companies will have a range of capabilities and preparedness on these issues, such as qualitative scenario analysis is permitted, and you will see the phrase all reasonable and supportable information at the reporting date without undue cost or efforts or commensurate with skills, capabilities, and resources in a number of places in our standards. And thirdly, the reliefs for the first year of application have also been introduced. So it includes the companies being able to limit disclosures to climate in year one and begin reporting on the other sustainability-related risks and opportunities in year two. And then also companies being able to provide annual sustainability-related financial disclosures with their next half-year reporting rather than at the same time as the financial statements. And thirdly, companies not needing to provide disclosures about Scope 3 GHG emissions apply the GHG protocol's corporate standard to measure emissions if they are already using a different measurement approach or provide comparative information in their year one of reporting using S1 and S2. Another relief allows companies to include GHG emissions information obtained from companies in the value chain with a different reporting cycle. And also we have also mentioned a number of other sources of guidance and resources, including SASB standards, CDSB frameworks, application guidance, among many others. So the above reliefs are designed to enable companies and players to put in place reporting practices and structures to provide high quality decision useful information. And lastly, the jurisdictions will decide whether to mandate adoption. But the standards are effective from 2024, January the 1st, and we know many companies are now preparing to adopt them voluntarily. So now we stop here to take another sample to test your knowledge to understand our ISSB standards. So the information disclosed in accordance with the ISSB standards should be A, decision useful, B, material, C, misleading, and D, comparable. Okay, we see C, we're expecting more participants here. So remember, this is like a multiple choice question. So it's testing your knowledge, like your understanding our ISSB disclosures. Okay, let me stop here. Yes, the correct answer is O, a C, but we can still see like a few like people have chosen misleading. So we actually like the purpose of like our information disclosure, it should be decision useful, material and comparable, and should be also decision useful. Okay. Okay, moving on. Let's have another sample to take a further test on your knowledge on the decision. Is decision useful if it is A, relevant and faithfully represent what it propose to represent, B, comparable, C, verifiable, D, timely, and E, understandable. This question is quite easy because we can see like most of the options are quite positive. Okay, let me stop here. Yes, the correct answers are all. So it's all the options correct. So we need to understand the information is decision useful if it has those characteristics. Okay, moving on. Let us move to the final session of our module, the confidence. So finally, the last session of our module is like we'll share with you how you can ensure that the users of financial reports have confidence in the data you're disclosing, as trust is an essential component of sustainability-related disclosures, and increasingly so with the growing concern over greenwashing. An important trust builder is showing data and trends over time. So that is why ISSB standards ask for comparatives. So comparative information provides context, helps to indicate progress and underpins strategy and risk management. And secondly, metrics disclosed by a company might be defined or replaced over time, or the company might change its method for estimating a metric. In these situations, it is important for the company to revise the comparatives to enable investors to compare and analyze current period figures with the relevant period figures. And occasionally, a company's sustainability disclosures might contain material errors. So in this situation, the company is required to restate these errors in the comparative providers. So revisions or restatements are necessary only when there is a risk that material information being omitted, misstated, or skewed as a result of not revising or restating the comparatives. And also, information can be qualitative and quantitative. So we know that like companies sometimes express concern with like sharing information they deem to be sensitive, or that if shared could like kind of like reduce their competitive advantage. So the ISSB standards relieve a company from disclosing information about accessibility related opportunity if that information is commercially sensitive. So if that is a concern you have, there is further detail you can read in the handout. So moving on, finally, it's important to build confidence by providing clear statements of compliance. A company that complies with all requirements in the ISO standards, even the release, is required to make an explicit statement of compliance. And we have also published further guidance on this in September 2024, called Voluntarily Applying ISO Standards, a guide for preparers. And there are things to remember. So to walk through firstly, it's like to walk through the list. And also you can find in the handouts and slide deck on an additional slide in this session, and with reminders of how to report effectively. And I highly recommend reviewing that. And now let me hand over to Fiona for the summary.
Brilliant. Thank you so much for rounding us off on that final module, Vanessa. That's fantastic. So as we said, that brings us now to the end of the content. So just stay with me for a few more minutes to wrap up, and we'll cover off a few closing points and resources. So just to take a quick moment to recap on what we learned in this module. Excuse me. So firstly, we discussed where to report information. And what was important here was that the audience, or who you're reporting to, so making sure to be clear from the start who the primary user of this information is, will really help you to ensure that this information is the right information for their needs. And then we talked about efficiency, and I think hopefully the key takeaway that you'll come away with from this segment is that less is more. So the objective isn't to overload your investors with information. Actually, that could be harmful because it could obscure the information that's required. So using the standards as you get started can be a good guide to make sure you're providing what information it is that investors need, because of course that's the purpose overall of the ISSB standards. And finally, Vanessa covered their report user confidence, and especially in the current climate of greenwashing and potential accusations and legal battles over public statements. Of course, it's more important than ever to ensure that the data that you provide is not only accurate, but it's presented in a way that builds confidence among report users. And so this is where the reporting plan that we've been discussing can help you to do this, because if it's done well, you'll have a clear and documented process for reporting the data that investors need. Okay, so with our final minutes of time, I think we will move probably quickly on from the communicate activity. I did have a quick question on there about different techniques to use, but that's something we can reflect on in our own time. But probably what we will do is just quickly revisit in Menti where we think we are now against those objectives that we gave ourselves at the start of the session. So Lois, if you wouldn't mind just resharing that chat link for one final time, just in case anyone needs it, that would be great. But just to get a sense really on how comfortable you feel now against those different areas that we set out to help on at the start of the session, and hopefully we'll be able to see a bit of an improvement. Thanks, Lois. Okay, so I think the one person who responded so far is happy and feeling much more confident. So, or maybe they were confident already, but anyway, they came back with a strong result, so that's good. But I'm seeing a few more responses come in, and overall, it looks like we're up in our confidence in these different areas. So that's great to see. Of course, we recognize in one training session, we can't solve all of the problems and detail that there is to discuss on these topics, but hopefully we've given you a bit of a structure to take away and to really understand the structure of the resources that you can access to understand different topics in more detail. Great. I'll leave that for you to respond on in the background while I just go back to cover a few final slides from our side. So we've mentioned a couple of times the homework assignment. As we said, this is an optional activity, so it's not mandatory and you don't need to submit it. However, the structure of the homework assignment is structured according to the same exercises we covered at the end of each module, just builds out a little bit more detail to help you to develop your disclosure plan. Yeah, we'd encourage you to look at that in your own time if you'd like to do so. So I'll just ask you guys if you wouldn't mind just resharing the links. I think we might have sent an old one by accident, which must have been outdated in our materials. But you can find the homework assignment in the resources section at the bottom of the event page that Lois will share with you. And just to mention a few overall things that will be helpful for you potentially. So firstly, there is the IFRS Knowledge Hub, which you can find at the link that Lois Lois has just provided the link to the webpage again, but the link to the IFRS Knowledge Hub is available in the slide handout presentation that you can find on that page, and also on the screen you can see the link there. We should also mention as well that the IFRS has recently launched 4 free e-learning modules to support adoption of the ISSB standards, which are self-paced, interactive knowledge checks, and also offer CPD accreditation certificates. So something to continue your learning or potentially to share with your colleagues as well. And of course, we'd highlight the standards themselves, and here's the link where you can download and access those directly. A few more resources to mention. The IFC, supporters of this program, their Beyond the Balance Sheet program of resources and training is another great resource, particularly on the topics of corporate governance, etc. And just for those asking, so the links to all of these resources are in the slide handout material. So if you go to the event page, the Bangladesh-ISSB page, bottom of there, you can download the slide presentation, and that will give you access to these materials. And then some final resources to cover before we come to the all-important topic of certificates, which I know people have asked about, just to highlight again the SSE's toolkit of resources that you can access to. So a big thank you and well done for everyone who stuck with us for the full 3.5 hours of training. We know that this is a long time and that there is a lot to learn, so we're very appreciative of all of you who've asked questions and engaged with us throughout this session. And as a merit for your hard work, you can now receive a certificate for completion of the course. So to receive your certificate, you will need to fill in a feedback survey, and the link to the feedback survey will be shared with you now in the chat by Lois. If you missed the link in the chat, but you can just see that Lois has just shared that now, so please follow that link. You'll also receive an email from Zoom 24 hours after the live training, and that will share the same link with you again. So if you've missed it in the chat, it is right there right now, but if you do miss it, you will also get an email from Zoom in the next 24 hours with the same link again. So once you fill out that survey, of course, we want to know your feedback on the programme as well, but we'll use the data that we collect there to send you your completion certificate. So you will receive your certificate around a week after taking part in the survey at a maximum. So please be patient and give us up to a week to send us your certificate. But if you don't receive it after a week and you have filled out the survey, you can reach out to the team in the contact details included at the end of the presentation to check on that. But do make sure to check your junk email folder just in case it's gone there by mistake. So just to close us out, just a final few words of thank you. Firstly, to the official supporters of the SSE, and then in particular to a big thank you to the participants in today's session. So of course, a big thank you to all of you for taking part, and to our hosts, the Chittagong Stock Exchange, for bringing us all together today. So finally, thank you to IFC and our partners at the IFRS Foundation, particularly Vanessa. Thank you, Vanessa, and to Robert for joining us today and sharing your expertise with us all. And a big thank you and well done again to everyone for taking part with us all here today. Hope to see you again on a future webinar, and we'll close the session there. Thanks very much, everyone. Thanks, bye.
Jesus.